Andy, are you on?
Ma'am, good morning.
Good morning. If we could have a roll call, please.
Governor Lujan Grisham. Commissioner Garcia Richard.
Here.
Treasurer Eichenberg.
Here.
Secretary Romero.
Here.
Mr. Jennings. Mr. Lavender.
I'm present.
Mr. Rawson.
Present.
Mr. Messina. Mr. Tejas.
Here.
Ms. Allen. Mr. Bingaman.
Present.
Madam Chair, we have a quorum.
Great, thank you, Andy. Next, we'll look at the approval of today's agenda. Do I have a motion to approve the agenda?
It's Harold, so moved.
This is Tim, I'll second.
Okay, we've got a motion by Member Lavender, a second by Member Eichenberg. Is there any discussion on that motion to approve the agenda? All right, Andy, if I could have a roll call vote for approval of the agenda?
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Secretary Romero.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes unanimously.
Okay, great. And next, we'll go to approval of the minutes from our January 25th meeting.
Move approval, Harold.
Okay, we've got a motion by Member Lavender. Do I have a second?
Second, John.
Okay, we've got a motion by Member Lavender, a second by Member Bingaman. Any discussion on a motion to approve the minutes from January 25th? Okay, hearing none, we'll have a roll call vote on the motion to approve the minutes.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Secretary Romero.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the minutes are unanimously approved.
All right, thank you for that very efficient procedure. Let's go on to agenda item 2A, the State Investment Officer briefing by Mr. Moise.
Thank you, Commissioner, and good morning to each of you. Beginning with item A on my briefing for February. Total distributions, or let's begin with total net asset value, as of Friday of last week was $36,054,121,000 plus a few. Distributions to the state from the funds over the last 12 months have totaled $1,119,638,000 plus. Total contribution from the state land office in neon, highlighted, if you will, for January, $167,823,369. Thank you, Commissioner, and thank you to those who have provided those funds. Otherwise, the $167 million for January of this year compares to $73,752,000 from the same month last year. Quite remarkable. Let's talk about oil price for just a moment. West Texas Intermediate, WTI, as of last Friday, was showing $91.69 per barrel. A year ago, it was $60.52 a barrel. New Mexico was showing $87.62 last Friday, up from $57.07 a year ago. Another remarkable increase. Let's look at rig count for a moment. This is the 17th straight weekly increase in the number of rigs in the United States. U.S. rig count as of Friday was 645, up from 397 a year ago. New Mexico's rigs totaled 94 as of Friday, up from 61 a year ago. Natural gas, U.S. pricing as of February 18th was $4.43 per MCF, per 1,000 cubic feet, if you will. A year ago, U.S. natural gas was showing $3.08 compared to that $4.43. Moving on to item 3 in my briefing, and we'll skip number 2. It's self-explanatory. The endowment effect, if you will. And how is that demonstrated best? I think in a couple of ways. By the multi-year growth in distributions, which is the fourth line down under item number 3, distributions. That multi-year growth from FY11 to FY22, going from $720 million per year to $1.154 billion. The 11-year total distributions have increased, or pardon me, the total distributions have been $9,714 million plus. So that's the way our sovereign wealth fund, our permanent funds, our endowment, if you will, operates. The most important part of that operation being how much we distribute to the state as well as to our beneficiaries. Let's look at number 5 under B, if you will, investment performance as of the end of last calendar year, December 31 of 21. This is net of fees. And I think the number to focus on, just for purposes of my comments, is the land grant total fund. And if you will look across that line, you'll see for 1 year, a remarkable number of 17.21%. And then the numbers we most focus on, the 3, 5, 7, and 10 years. You can see those numbers. 3 years, 13.65, 5 years, 10.74, 7 years, 8.71, and an important 10-year number of 9.81%. Let's move down, if you will, to item C, council matters. You can see the meeting dates for March. And then number 2, I've titled Investment Review Process. I might have more clearly stated Investment Review, Approval, and Implementation Process. So what is this all about? It is studying those best practices among our peers, whether it's sovereign wealth funds or pensions. We've been asked by the CIC to generate a report on that topic, and Vince and I are working with RVK to come up with that for the next CIC meeting. Under operations, we'd like to talk about our successes in recruiting and our pending sourcing or recruiting, if you will. You can see that we have a fixed income asset class director listed there, and we'll be having an interview or interviews with a candidate this week in person in Santa Fe. And we looks like we have a very well qualified individual. We're also looking for 3 analysts, one in the real estate, real return area, another in the fixed income world, and another in our accounting department. I'm going to ask Charlie to report to us, if you will, please, on legislative matters as well as on clients. Charlie?
Thank you, Steve. Madam Chair, I'll try to be brief. We have a long agenda. So we tracked a lot of bills during the session. There were 3 that passed that have some kind of impact, either direct or indirect, to the council. House Bill 104 is the Venture Capital Program Act. This appropriated through House Bill 2 $50 million general fund dollars to a new venture capital effort to be run by the New Mexico Finance Authority. The program is statutorily similar to the SIC's program, but will be overseen by NMFA. Assuming governor signs that bill, this would take effect July 1. And the ultimate impact here is SIC won't be the only one making investments in venture capital anymore. NMFA will. Also, EDD is, I believe, working around some federal money through SSBCI. More on that to come up in coming months. House Bill 148 is... Yes.
Excuse me, can I ask just a quick question? Madam Chair, this is Lee.
Yes, Member Rawson.
I'm sorry to interrupt you, Charlie, but it raises the question as to how do we manage to, as a state, not to be providing funding from various places like the SEC, the SBIC, now this fund. I think we're going to have to be guarded that the state's not providing, the significant amount of the total pot of the loans to this group, whoever the applicant may be. So I'm just guarded that we have some mechanism in place, and I know you might have to develop that, but I can see this getting to be a problem. Anyway, I'll leave it at that.
Madam Chair, moving on, House Bill 148 is an extension of the Small Business Recovery Act. That was the $500 million low-cost small business loan investment program administered by the NMFA using severance tax permanent fund dollars. The extension runs to the end of calendar year 22, and the full reversion of those funds to the STPF was also extended till the end of 23. Now, keep in mind, NMFA does not hold that whole $500 million at this time. They draw it down in bite sizes of about $20 million based on demand. So that limits some of the drag on our investment returns. Senate Bill 134, this is the severance tax bonding for New Mexico Housing Trust. Essentially what this bill does is it amends the Severance Tax Bonding Act to allow for 2.5% bonding capacity to the Housing Trust Fund. This may likely reduce the overall amount of dollars flowing in to the Severance Tax Permanent Fund. We get our money after the bonding process is complete. This adds another beneficiary to that bonding process for about $24 million per year was the analysis that LFC developed. Regarding clients, we are still expecting 2 new clients to be added in the coming months, Western New Mexico University and North Central Regional Transit District. We've also been asked to present information to the Curry County Commission coming up in May regarding SIC investment pools. As you're probably aware, we do have some existing clients out in that part of New Mexico, Clovis Community College, Eastern New Mexico University, and the Clovis Carver Library Trust. I would like to think that there's some word-of-mouth positivity that's driving this interest. We'll see. Barring any questions about the client pools or legislative matters, that concludes my report.
And that concludes my report also, Commissioner. Thank you.
Thank you, gentlemen. Questions from the council for either Mr. Moise or Mr. Woolman? All right, hearing none, we're going to move on to agenda item 2B, the Chief Investment Officer briefing by Mr. Smith.
Thanks, Madam Chair. Good morning, everyone. Well, we definitely have a full agenda for you today. We gave you some warning, I guess, last fall and into the winter that the fundraising cycle looked large anyway this winter. So it is. A lot of funds last month, a lot more this month. We'll definitely see a slowdown in March and April for sure, and we'll kick up the macro presentations in those months. So we'll keep you a full agenda, just fewer investments, I think, going forward. But today, lots of work here. In addition to those, we've got performance reports, December for the entire portfolio, and then the third quarter reports for the private asset classes. So lots of work for you today. On the macro front, the economy's still looking fairly strong. Risks are definitely up. We've all been watching inflation tick higher, both in consumer prices and producer prices. I think the PPI, the producer price index, was up a full percentage point at the last print. So that's a little over 12% per year in producer price inflation. It's not just there; it's also in some assets. The latest Case-Shiller report for housing here in the U.S., I think, was close to 19%, 18.8%. I think was the print for December. So still lots of inflation going through in the economy. I think, unfortunately, it looks like it's starting to seep into some of the stickier areas of inflation. So wages and rents and future expectations. Those things tend to be sticky. So once wage increases are given, they're rarely taken back, and once rents go up, they rarely come back down, at least in a whole part, without a big recession. And same thing on future expectations. Once people start building into their models and into their minds, inflation is going to be higher and start acting on that basis. That tends to be sticky too. So we're keeping a close eye there. We think the Fed's got a pretty tough job going forward from here. Inflation hurts everybody, and they're one of their two tasks is to control the price level. So there's no doubt the Fed will be acting. I think we're talking about a 50 basis point increase in short-term rates next month. It's probably a toss-up, 50-50, whether it'll be 50 basis points or 25. Well, I do think between 75 and 100 basis points are coming in the next 3 or 4 months. So we'll definitely get a lift off of rates, and we'll see how that hits the economy and how that affects inflation, and the Fed will take it from there. I've seen forecasts as high as 9 increases, so that rough 2.5 percentage points, which would be a lot, and would put us at risk of recession. The other option for the Fed is to begin raising rates if markets crater and the economy slows a little bit, reversing course. I don't think that'll break the back of what's going on right now. So we'll have to watch if that's ultimately the path the Fed takes. I think we should continue to be concerned about kind of sticky inflation in the economy. So chances of us seeing a recession fourth quarter of this year, first quarter next year is the first down quarter in GDP growth. Might be around 30 to 50%, and increasing if the Fed gets tough and tries to get that inflation down. So just keeping our eyes open. Stocks have corrected a little bit, trying to make adjustments for. We're down 8 or 9% from the peaks as of today. Interest rates are definitely higher. We hit 50 basis points on the 10-year yield during the initial stages of the pandemic. We're back up near 2%, about 1.92 today, I saw, on the 10-year Treasury bond. So rates are up, stocks are down. That's not unusual or not unexpected for what's been going on so far in the economy. So just watching close to see how the various markets respond. With that, I guess maybe just let me talk about performance. Steve talked about performance a little bit. Just fantastic numbers. Just very pleased at what we've been able to earn over the last 10 years. Steve pointed out that number. That is one we keep our eye on closely. Almost 10% there. I think back to what our forecasts were, or what our expectations were for returns back in 2010, 2012, that time frame, and we're probably 200 basis points ahead of that. So on a compound basis. So just fantastic returns. I know Marcia and Matthias will go through those in their executive summary here in just a minute. Lastly, Steve did mention recruiting. We're having some luck on the fixed income side, so we're looking forward to an interview. It was somebody we've talked to in the past that's been interested in coming to work for us. So, highly qualified person with the kind of experience that we like to see. So we'll be talking with him later on this week, as Steve mentioned, and still hopeful for the analyst hires. We've had some good candidates come in through the pool. It tends to just be a matter of time with the analyst roles to get folks into those. So with that, Madam Chair, I'll stop and take any questions that you want on the macro piece, and then we can move on to RVK.
All right. So before we go into our December performance report, any questions for Mr. Smith on the CIO briefing? And because our packed agenda has been mentioned now more than once, I just wanted to let folks know, if anyone is listening on from the public, we were to have had a report out on our renewable energy investment numbers in this meeting, but because of the length of this agenda, we're pushing that to hopefully our March meeting. So I just wanted to let folks know, in case you're listening in for that and you haven't seen the agenda, we're going to try to do that report out in the March meeting. Okay, we'll move on to our December performance report with Mr. Smith and our representatives from RVK.
Okay, thank you, Madam Chair. Good morning, everyone, and thanks, Vince, for the macro comments. I'll try to add on to that just a little bit. Today, we do have the fourth quarter executive summary in your packet, and we'll spend the majority of the time reviewing that. I'll provide just a few additional comments related to the capital market environment, and then Marsh is going to give you the actual fund performance and the underlying pieces that resulted in the good returns that both Steve and Vince mentioned. Overall, the asset allocation is working very well in this environment, particularly. I think that's been fairly well communicated in the investment plans that Vince provides you on an annual basis. And so that's resulted in very, very attractive absolute and relative performance that we'll spend some time looking at. In terms of capital markets, we can start off on page 23 of the meeting materials. That will provide you just a very high-level snapshot of where things stood at the end of the calendar year. The bottom table on the left side there provides the trailing market returns. We look at that periodically. And as you look at that first column, QTD, quarter to date, essentially representing the fourth quarter, you'll see that it was another good quarter, essentially for most global assets, although we did see quite a bit more intra-quarter volatility. So just looking at those numbers don't give you the full picture. We've had a fairly wild ride during that quarter and really into this first part of 2022 as well, which we'll touch on. The year finished with another double-digit return, really, for most of the equities except emerging markets. That was largely due to pretty strong U.S. dollar and regulatory headwinds in China that we've touched on previously, but very good results from really all the risk assets, again, on the back of already very strong returns in prior years. You can see the S&P 500 up nearly 30%, in developed markets breaking into the teens. So strong returns, and that's really resulted in long-term performance numbers that I think have exceeded most of our expectations, and certainly are beyond what the long-run average is. And that, of course, factors into our forward expectations, as we talked about, and as we'll spend some more time discussing in future meetings. So equity valuations remain near their record highs, although, as Vince mentioned, we had a little bit of a sell-off this year. Domestic markets down about 9% through Friday, 4% for developed international markets. So a bit of a correction there, although still PE ratios are not as high as they've been. And those sectors that have sold off the most, such as technology, were previously the best. Of course, when you have those sectors that are stretched, that are highly dependent on cheap financing, those are going to be the first ones to come under pressure as interest rates begin to move up, and that's already started can also see, as you're looking at that table, the other part that's red is the Bloomberg U.S. Aggregate Bond Index, so the broad fixed income market that really came under pressure and still remains under pressure as those rates have started to move up, and in large part due to inflation exceeding expectations. You can see the Treasury yield curve. So if you want to see that visually on the right-hand side at different points in time, and you can see as you're comparing 2020 year end, that's the green line, or the yellow line rather, to the green line, which is 2021, a steady increase over that 1 year period. And so as a result, that has put some downward pressure on the fixed income market, and you're seeing some negative returns, not materially, but for the fixed income space, not insignificant for the prior calendar year. The 10-year Treasury is just shy of 2% right about now, and that's up 50 basis points from year end, where it was 1.5. We have seen the broad fixed income market extend in terms of its duration or interest rate sensitivity. And when you have that coupled with very low starting yields, even a small upward movement in interest rates can have a fairly significant impact on returns. And so that's something to be mindful of. Again, if rates move up 50 basis points and the starting point is 5 or 6%, that's very different than when rates are barely over 1%. So we talked about the interest rate sensitivity, and you've taken a thoughtful approach there, splitting out fixed income between core and non-core. And the non-core fixed income allocation, as you'll see when Marcia provides you those details, performing exactly as expected. They have a lower duration profile, so they're not as exposed to changes in interest rates, and are performing quite well. So that was very thoughtful change and looking down the road. Lots of talk about inflation. We've talked about it previously. It is running above expectations, up about 7.5% on a year-over-year basis at the end of January. That's up from 7% at year end. And so, as Vince mentioned, the Fed is really needing to balance their dual mandate here and try to rein in inflation, since it is at levels that we haven't seen since the early 80s. Much of this initial rate hikes already priced in, but at this point it's a matter of how high and how quickly they'll have to raise rates to try and control things, if they can, at this point in a meaningful way. All of this, though, when you put it together, has led to real assets. So the last few lines on that table, real estate, commodities, other assets with a direct linkage to inflation and generally higher levels of income. We've heard that theme over a number of years, emphasis away from just appreciation, but also on steady income, doing exceedingly well. So that you can see those being top performers. And that's also true when you look at your asset class returns, and that should continue to be additive. Now, these are asset classes that really have been put in the shadows in a way over the last 5+ years with the very strong equity returns that we've seen. But this is exactly the type of environment where we're seeing that diversification and those types of assets earning their keep in the portfolio. Steve already touched on oil prices in his briefing. I just wanted to add that obviously with what's going on with the Russia-Ukraine conflict, that's pushed crude prices up even further, and may be approaching $100 now, given some of the supply concerns there and overall uncertainty. So that's weighing on the markets now, although we think that the interest rate outlook is likely going to have a more meaningful impact than the geopolitical risks that are currently present. So overall, I think it's a good environment. You're well positioned. The strategic allocation that you do have is working quite well, and we anticipate it will continue to perform as expected. So be happy to take any questions that anyone has, and otherwise we'll turn it over to Marcia for the actual portfolio results.
Marcia?
Thank you, Matthias, and good morning, Madam Chair and council members. We're going to step back in this report. It's December 31st. So first, I'm going to take you to page 26 of diligence and look at asset allocation. It's really no different story here. To the left is the land grant. Vince has talked to you about having cash in the portfolio. Thank you, Madam Commissioner. Cash is coming in, and it's difficult to get that deployed into the more private assets. So you can see out of target to non-core fixed income and real return for the land grant. Certainly, you've been working pretty hard on getting more money deployed over the last couple meetings. So a couple things going on here. You have, again, the fortunate problem of having cash come in, and also at this point, strong equity markets. So difficult to keep at your target with those two positives going. Severance tax, you're within the range, but you can still see an overweight at that point to U.S. equity and some underweights to the private assets. So we go to the next page, page 27, you can see the allocations for the other funds, mostly very close to target, still implementing the early childhood. Let's now go and look at the performance on page 29, referenced by Steve and Vince and Matthias. At the bottom, we show land grant gross of fees and net of fees, and severance tax the same. Strong quarter for both. The land grant was up, net of fees, 465 basis points, beating its benchmark, net of fees, and for severance. Actually nice seeing outperformance against its benchmark as well on a net growth and obviously net of fees basis as well. That carries through the 1 year number, but the focus on through your investment policy benchmarks is on the 5 year. On a 5 year basis, looking at the land grant, both on a gross and net of fees basis, and being its policy index, with a strong return, net of fees of 10.57. On an absolute basis, the severance tax performed over 9%. So on a net of fees, 9.25%, but trailing its benchmark for that longer term policy index of 5 years. Just pointing out also that Vince was mentioned the 10-year return just under, getting close to 10%, 9.65 on a net of fees basis, and again beating the policy benchmark. The land grant, a little bit different story for the severance tax. So if we look at a policy review, as the top part of this page, you've met your policy benchmark or expectation for the land grant. You have not for the severance tax. So we'll talk more about that in a moment. Just quickly looking at attribution of performance for the quarter. This is just for the quarter. And the green was your quarter return on a gross of fees basis. The blue is what came from being at your strategic target allocation. So most of your return, as we've always talked about, comes from your allocation decision. In this case, being away from your target was pretty neutral, and style biases was pretty neutral. So the outperformance for the quarter for land grant was manager skill. And if you look at the bottom part of the chart to the far right, you can see where that came from. A big hunk of that came from real estate, and also some from non-U.S. equities and from your private assets. On page 31, the same information looking for the full year. And again, the land grant outperformed its benchmark. Most of that return came from the benchmark. A few negatives from being away from target. Again, had some cash and some style biases were slight headwind, but manager skill added, and so you outperformed your benchmark. I'm going to take you to page, can't That says 32, and this is for the severance tax. As we mentioned, severance tax outperformed its benchmark for the quarter, so great news there. Performance coming from the allocation, obviously, but also getting some contribution from manager skill. The biggest contributor was manager skill here for severance tax. Again, biggest contributor was real estate, as you can see on the bottom right. And then different little, looking for the 1 year as well, same story, beating the benchmark for severance tax, which is nice to see. Manager skill was the contributor there, again, mostly those private assets. The next few pages look at the full calendar year. The top is showing the total fund and the assets at the beginning of the year and at the end of the year, and showing that strong cash flow, but also the strong gain of just under $5 billion. And then we break it out by each of the funds, first land grant and severance tax. On page 34, going to page 35, we also show the other funds, certainly seeing the funds with negative cash flow coming from the water and slide from the rural libraries, but also early childhood for this period. And then external clients, again, those using the unitized funds, strong inflow there as well as gains. Let's now go to page 38. Again, it's not an objective in your investment policy, but we always look at how you did against your peers. We've listed at the top what your true objectives are for the performance. In this case, the land grant, again, peers are not listed as an objective, but we show the returns of the land grant and the policy index at the top, and then we show different universes. Let's focus on the first universe, which is all public plans greater than $1 billion. The median return for that universe for the quarter was 4.13. You beat that, and you ranked in the 26th percentile in this universe for the quarter. For the calendar year, you ranked in the 20th percentile, and then for the 5-year, which is the focus of your investment policy, slightly below median, it's the 56th percentile, but going out for the 7 and 10 years, well above median for those time periods. So that's for the land grant. When we look at that, again, your investment policy talks about rolling or 5-year periods. We don't talk about peers in the policy, but we're showing you your ranks for those 5-year rolling periods. Each dot is a look back to the 5 years. Really, since 2014, you've been very close and mostly above median compared to your peers. The last year, we saw you drop below median for the 5-year for a period of time. Again, you have less U.S. equity exposure in your market, in your portfolio. That was a headwind for you, but you can see that the two last dots are moving very or close to the rank. The 5-year, again, as at the end of 2021, was 56th percentile. So close to median. We want you to be close to median and not the highs and lows that you experienced in the prior years. But what we will also focus on is that risk-adjusted return. So when we compare your Sharpe ratio to that of your peers, so your risk-adjusted return, you can see you rank in the top quartile and have been for the last several years, really beginning in 2016. So that is a number that you should be proud of. So taking into account the volatility of your portfolio, that risk-adjusted performance has been quite strong relative to your peers. The severance tax on page 41, the ranks there, as you would expect, not as good. Slight difference in allocation, but mostly some underperformance there. So your ranks, your 5-year rank there is much lower. and you're at median on your fiscal year to date, but every other time period below median. Let's go to page 43 and look at some other information against benchmark and against peers. The top left-hand chart is looking at this universe of public lands greater than $1 billion. Each square is another plan in there. In this universe, the green triangle is a land grant. The blue is severance tax. Again, just to mention that if you compare the green triangle to the yellow, the green diamond to the yellow triangle, that's the land grant actual performance versus policy. We know that you outperformed your policy there, but how did you do in this universe of peers? And in that case, for the land grant, for the 5-year period, if you look at median, the median return for that 5-year period was 10.66. You were at 10.57. So you had 99% of the median return, but you got there with much less volatility. The land grant volatility was 8.02 standard deviation, where median was 10.92. So you had 99% of the median return and only 73% of the median volatility. That's a good place to be, and that's why you're on the left-hand side of that chart, so lower volatility. For severance tax, which is the blue, again, we know that severance tax underperformed its policy benchmark, but so if we look at its performance against the median, did not do as well as land grant, but again, the volatility was much lower. And then we have the same information for 10 years, for the 10-year period for land grant, beating its benchmark, as well as falling in that northwest quadrant with higher return at lower volatility compared to peers. Any questions before we go into asset class? If not, there's a summary on page 45, but I'm just going to cover the more public asset classes and non-core, because you do have reports from your private asset class consultants. So going to page 47 for the U.S. equity composite, there's no changes to the structure during this period, so no manager hires or terminations. Performance for U.S. equity, you have not, your benchmark is to outperform the Russell 3000 over a trailing 5-year period. You did not meet that. You trailed it by 95 basis points. We talked about the change to this portfolio, and hopefully tracking error will be reduced, has been reduced. If you look below in that table, you can see that the large cap piece of the portfolio trailed its benchmark of the Russell 1000, but the small cap piece of the portfolio had nice outperformance relative to its benchmark for the quarter, and the same is true for the 1-year period. 5-year, both of them trailed the benchmark. So changes have been made to the U.S. equity portfolio. If we go to page 49, you can see this again. The underperformance of blue is the Russell 3000. The green is your U.S. equity composite. If we compare that to the universe of other U.S. equity portfolios, you're about median return, but you have less volatility than the median U.S. equity portfolio. So not a bad place to be, just wanting to see that triangle get up in that northwest quadrant. On page 40 of
Madam Chair. Madam Chair,
Mr. Treasurer.
thank you. Marcia, before you go on, why is everything gross of fees over the last couple of pages that you just presented? I mean, on page 45, it's gross. 47, it's gross. 48, it's gross. Why are we just showing gross?
On page 148, we do show the net of fees performance. The universe we're showing here is gross of fees. The net of fees universe is being built out. So, but we do show net of fees performance, but we can't do the net of fees return in the gross of fees universe. So more to come on that as the universes are being built out. So good question.
You told me that before, and I just wanted to get it on the record, so to speak. I noticed you, S&P had a better return again than we did on private equity. What are we trying to do? And I don't know if that's a question for you or Vince, but what are we doing differently?
Well, I'm sure that Vince and the special consultants will have more to talk on that. But you know, it's been we're talking about private equity for what? Are you looking at page 45?
I'm looking at 45. You know, I just looked at S&P and it was at 16.5% as of 12/31. But we're at 14.7. And Madam Chair, I know that's a long meeting. I guess I could do this offline another time.
Or is there someone who wants to respond? I don't know.
So, Tricia, you're looking at the 10-year number for the private equity composite. Is that the 14.7?
Kim? Treasurer? Page 45.
I'm sorry, Marcy. We're kind of going in and out, so I apologize to you for that. And again, Madam Chair, I'm happy to do this offline. So thank you.
We'll just see if anyone wants to respond to that at this time.
I think when you get to your specialty consultant reports where their performance is more IRR based, and you know, we can have a further discussion there. Also, you have to, I would comment that just that the equity markets and the S&P's been quite strong. Certainly a different case going into this year, but we can have more of a discussion that when we see the reports from the specialty consultant.
So if Mr. Lee could take note to maybe respond to that in his presentation.
Absolutely.
Page 52, looking at your non-U.S. structure, no changes there either. If we go to page 53, you can see the gross return and the net of fees return for the quarter outperformed the benchmark, which is the World ex-U.S. The gross return for 5-year and the net return for 5-year also outperforming that benchmark for your policy. So that's, you see the yes there. So outperformance for your non-U.S. equities meeting its investment policy benchmark. We show the risk return on page 54 again. Portfolio beating benchmark. We look at the universe of peers, slightly below median volatility. Peers performing a little bit better than the portfolio, but again, beating the benchmark that you set for it. But if you're interested, on page 55, you can see the market cap and also the regional weights of your non-U.S. equity portfolio showing exposure to emerging markets and developed markets. And then going to fixed income on page 57, no changes here to your core portfolio. Obviously, you've been trying to get funded up to your target in non-core, but let's look at performance. Performance on page 58 for the core fixed income. Nice job of outperforming its benchmark for the quarter for both the core and non-core. But against your policy benchmark, the same is true going out to the 5-year where your core portfolio outperformed as did the non-core portfolio. We also have data on page 59 showing again everything together, both beating the ag benchmark and doing it at less volatility than the ag. And then the balance of the report gets into the policy benchmarks for the alternative. I think that discussion is best set with your specialty consultants because they, again, when you have the quarter lag and they also have more up-to-date performance in private equity, especially with the IRR. So with that, Matthias, and I'll take any questions.
Questions from council? All right, thank you very much. We'll move now to our PMRs. We're going to start with real estate. Agenda item 2B. I'll turn it over to Mr. Sable and our consultants from council.
Good morning. This is Keith Sable, Director of Real Estate and Real Return. Got a heavy agenda this morning with 4 items on the agenda, including PMRs for both asset classes and 2 proposed commitments in real estate that we'll discuss later during the course of the meeting. Joining me this morning from Townsend are Seth Marcus and Andrew Bradley. I'll ask Andrew to start off with the real estate PMR, allowing a pause for questions before wrapping up with the real return PMR. Andrew?
Good morning, everyone. And Keith, thank you for the warm introduction. What should be the first of many. Plan to keep this on the briefer side. As noted, we have quite a lengthy agenda. The materials we'll be reviewing start on page 68 of diligence. And as a reminder, the reference performance is as of third quarter 2021, as private markets typically lag a quarter due to reporting timelines. With that noted, let's go ahead and dig into the materials. As of quarter end, the allocation to real estate was 10.3% based on market value versus our 12% target. This was an increase of 60 basis points quarter over quarter as the growth of the real estate portfolio outpaced growth of the overall plan. And to simply tie a dollar value to this growth, the portfolio increased quarter over quarter by just over $244 million. And that number is net of distributions. We saw appreciation broadly across the portfolio of just over $286 million. $286 million equates to approximately 9% of appreciation for the quarter at the portfolio level, which was significant for just one single quarter. During the quarter, we continued to observe a strong and swift recovery in the broader market, but more specifically in the real estate portfolio, as the portfolio produced an 8.4% net return, resulting in outperformance of 200 basis points, and now an unprecedented 720 basis points of outperformance over the 1-year time period. This 20.8% total portfolio net return for the 1-year time period was broad-based across each sub-portfolio and just farther amplifies outperformance of our NFI out-of-the benchmark over all time periods. To provide a bit more context on this performance, the typical expectation for core real estate is a definite 9% annual net return. And we almost met that expectation in a single quarter as the core portfolio produced a 6.9% net return. This was driven not only by the recovery, but our strategic allocation of industrial, multifamily, and the specialty sector property types. To temper expectations just a bit, I would expect strong performance going forward, but not necessarily get comfortable with this level of performance. We took a look back during inception of the total portfolio in 2004, and this is the highest single quarter performance on record, which is outstanding, but just wanted to note strong performance going forward, but that's to this level. And then to dive one layer deeper into this performance breakdown, both the core and non-core portfolios individually outperformed NFI Odyssey over the quarter, 1, rate, 5, and 7-year time periods. Now, could go on and on. Very happy about this performance, but I'll move myself along to some other portfolio points. It is important to note that the portfolio continues to outperform while at the same time reducing the overall fee load. As NMSSC and Townsend continue to collaborate and take advantage of fee savings when accessible. And this is driven by Townsend's ability to aggregate client cap commitments and negotiate fee savings for all clients based on weighted capital. That number stood at $2.5 million annually as of the third quarter from 9 managers and 14 individual funds throughout NMSSC's real estate portfolio. And before wrapping up, I would like to highlight that NMSSC has fully committed to the 2021 vintage year and has begun approving 2022 vintage year commitments in the fourth quarter. As you've all seen there, I came through the CNC and SFD. We did this as a number of strong opportunities with highly regarded managers who are available in the market for a very, very constrained period of time. So we want to take advantage of those opportunities. Seth plans to touch a bit more on pacing during his presentation of 2 new investment proposals later on in the meeting. And as I've kept it briefer than usual, I would like to remind everyone that all the typical slides and information are still present in the deck and available for your viewing. I'll wrap it up there and open it up to any questions on the real estate portfolio.
Great, thank you, Andrew. Questions for Townsend or Mr. Sable on real estate PMR? All right, let's move on to real returns.
Perfect. As we dive into the real return portfolio, just so everyone is able to follow along, the reference materials will begin on page 105 of diligence. And just to serve as a reminder to the broader group, the real return allocation has been lowered from 12% to 10% in May of 2021. The real return portfolio currently stands at 8.9% of total plan assets based on market value. The financial assets and MLP portion of the portfolio currently make up just under 21% of the real return portfolio. The remaining 79% being real assets. And this breakdown closely matches our sub-allocation targets of 20% and 80%. So almost right on target for the portfolio. Both the real return and real assets portfolios have performed well in the short term, specifically over the quarter and the 1-year time period. Over the 1-year time period, both the real assets and real return portfolios outperformed the CPI plus 300 basis points benchmark by 450 basis points and 1,020 basis points, respectively. As a reminder, the significant difference between the 2 portfolios and those returns is driven mainly by our MLP position, which has been referenced numerous times in the past and has been volatile given public market exposure to the energy sector. This position produced a 1-year net return of 70.8% as a positive return, yet remains flat over its life. And just to further highlight the volatility we've experienced in this position, and to speak a bit on what has occurred in the public energy market, this same quarter last year, the MLP portfolio's 1-year net return stood at a negative 40%. The position now sits at a positive 70.8%. To move along and focus a bit deeper on the real asset portfolio, as a result of the reduction in target allocation for the entire real return portfolio, the target allocation for real assets now stands at a flat 8%. Based on third quarter market value, the real assets portfolio is currently sitting at 7.1% of total plan assets, and when unfunded commitments are included, the real assets portfolio represents approximately 9.1% of the total plan. This allocation slowly crept forward during the quarter to the tune of 10 basis points based on market value, as the portfolio increased $77 million quarter over quarter. Again, net of the distribution. We do anticipate this allocation will continue to increase as uncalled capital is deployed and new commitments begin to call capital over the coming years. One last thing I would like to highlight is the attribution slide. You will find this, for reference, this graphic can be found on page 114 of the literature. Of the strong 13% one-year net return for the real asset portfolio, each underlying sub-portfolio positively contributed, which I think is important to highlight. Infrastructure was the top contributor to the tune of 6.5% of this overall 13%, or approximately half of the overall portfolio return. Oh, and one thing I would like to highlight is we did hit a large milestone during the quarter as our infrastructure portfolio eclipsed the $1 billion mark and now makes up approximately 46% of the real asset portfolio. We do anticipate that the exposure will continue to climb slowly as committed capital is deployed from recent investments and we continue to focus efforts on infrastructure going forward. To get back to the attribution chart, energy was the other major contributor to the tune of 4.9% as the energy sector continues to benefit from recovery and valuation following the significant write-downs suffered in early 2020 during the early days of the global pandemic. As highlighted, all other sub-portfolios contributed positively for the quarter, just had minimal impact due to their size. Similar to real estate, you'll find all usual materials and information in the remainder of the performance deck for your viewing pleasure. And I'll wrap my comments up there and open to any questions on the real return portfolio.
Great, thank you, Andrew. Questions on real return PMR? Okay, we'll turn then to private equity. We'll start first with the National Private Equity PMR, Mr. Lee, and our consultants from Mercer.
Thank you, Madam Chair. I'm joined by Chris Cassidy and also Richard Pugmire and Amy Ridge from Mercer. This is the third quarter national PMR, so we are 1 quarter lagged from the public markets and the RBK presentation that they went for the real estate and real return. So just a reminder to everybody, these materials start on page 145, and Richard Pugmire will probably begin his comments on 148. I would also like to address the Treasurer's question about a private equity performance return versus S&P return, whether that was underperformance and how significant that was. We look at the private equity performance and we try to find an appropriate benchmark. There's all these benchmarks have some issues with them, so we're just going to try our best. And that's why you see different benchmarks on different pages. In the RBK report, for instance, they list a Cambridge U.S. Private Equity Index and then also an MSCI World Index, All Country World Index, plus 3%. The results have been a little bit mixed. I think if you're referring to page 61 of the report, that shows that the private equity composite was about 58 basis points behind the Cambridge U.S. Private Equity Index. That is a U.S. funds, and we do put a fair number of commitments internationally, both in Europe and in Asia. The majority of the commitments and the majority of the NAV is still in the U.S., but we do feel like any benchmark would be closer to appropriate if it captured both international and U.S. In different time periods, as demonstrated in history, the U.S. public markets can outperform international and then vice versa. It just so happens that in both the last 5 years and the last 10 years, the U.S. equity markets have outperformed international. So that's probably the best explanation I can give for why when you're looking at a U.S. only benchmark, you want to sort of keep in mind that our portfolio is international. It is majority U.S., but it does contain a fair amount of, as I said, European managers and some Asian managers. And we can also talk to the question on page 153 of the report that shows the public market equivalent, but I'll wait for Richard to get to there. And with that, I'll turn it over to Richard.
Great, thanks, David. I will start on page 148. We're covering Q3 2021 performance today. The headline is we saw another strong quarter of performance in the national program, which has continued the trend that we've had since Q2 2020. The quarterly return generated a gain of approximately $275 million, which wasn't as large as last quarter's gain of $435 million, but still a large quarterly gain when you compare it to what we've seen historically in the program. And this first slide has an overview of the performance and commitment activity we've done recently. The horizon returns at the bottom show the strength of the recent performance that we've seen in the portfolio, with the 1-year return near a 50% net IRR and the 3-year return at a 22%. From a since inception standpoint, the 2011 and after funds have generated a 19.7% return, and the program's overall return has generated a 13.1% return.
Sorry, Richard, and maybe this would be a good time to remind the council that the specialty consultant performance returns are based off of IRRs, internal rates of return, and that's standard in our industry. The RVK returns should be a little bit different because they're not based on IRRs; they're based on rates of return.
Yeah, and I could point to the 10-year IRR on this page. The 15.1% is the equivalent return as that 14.7% return in the RBK report, which is the time-weighted return. In private equity, we focus on the dollar-weighted returns or the internal rate of return due to the unique characteristics with managers having discretion to draw capital and then also distribute capital at their own discretion. The 10-year return isn't too different at 15.1%, but one thing that I think this breakdown shows is the legacy portfolio, the 2009 and before, continues to have an influence on the 10-year performance, although this influence declines at the 5-year and more recent horizons as that portfolio has become more realized and doesn't have the assets in the ground anymore. Moving to the next slide, 149. This slide has a summary of the numbers in the portfolio. And just to highlight a few, net asset value increased by $136 million, which continues that trend of net asset value increases that we've had. One of the interesting things about this period that we've been in are the performance increases have been accompanied by realizations or distributions coming back to the SIC. So the net asset value gain is actually not as large as the performance gain because it's offset by distributions. And I'll illustrate that more on the next slide. Year over year, this table shows the impact that the recent return has had on the since inception returns, as both net multiple and net IRR have increased. The overall net multiple has increased to 1.6 times from 1.45 times, and the since inception net IRR increased to about 13% from 11.5%. Page 150, this graph shows the changes in the net asset value over the last 2 quarters. All strategies contributed to the gain, but remember with the national program, we do have a small venture capital program right now, which we've just started building up over the last few years, and that's going to take time to contribute to returns. But the gains were also widespread with 65 funds reporting net gains. You'll see in the graph below that we continue to see large amounts of distributions, which were over $200 million in both of the last 2 quarters, Q2 and Q3. That offset some of the net asset value increases from the contributions and the portfolio gains. And this shows through September 30th because it's the most updated performance date that we have. But we have the cash flows through Q4, and distributions had a lot of activity in the fourth quarter at $319 million. So for 2021, we actually ended up with a total of over $1 billion of distributions in the national program. And then there was also about $500 million of contributions for the year. So there was a net $500 million of distributions received by the SIC.
And just for context, even though the portfolio has been growing bigger, that over $1 billion distributions was by far the largest in program's history.
Great, yeah, thanks, David. Page 151, this shows the highlights of the contributions, distributions, and gains and losses. I mean, the overall theme I'd say here that's one difference that we saw this quarter compared to the last few quarters is there were some notable unrealized losses in the funds that you can see on this page. With the strength of the public markets, we've been seeing more IPOs and more companies go public, which leads to more volatility and performance for some funds. They mark these to market to the publicly traded price. And the losses here were largely driven by publicly traded companies trading at lower prices as of September 30th. And they are unrealized companies. And given the recent market behavior, this could ultimately be a drag for the Q4 performance as well. However, the gains are still very strong through September 30th, with 10 funds having a gain greater than $10 million in the quarter. The next page, 152, shows a by vintage year look at the portfolio's performance against the Burgess Private Markets benchmark. And since 2011, performance has been above median in all years except 2013. Absolute performance has also been strong across multiple vintage years in the 2011 and after, with every year but 2013 generating a 14% or greater return. We talk about the importance of having vintage year diversification in the strategy because you just don't know what years are going to be relatively stronger. And 2016 and 17 have emerged to be really strong vintage years so far, with net IRRs greater than 24%. The next page, 153, has the public market equivalent return calculated over the last 10 years. And the way that this is calculated is it does the dollar-weighted equivalent or IRR equivalent return with the public market indices by using the cash flows from the portfolio and investing them in the index values. And the MSCI ACWI benchmark covers multiple countries and geographies, including the US, Europe, and Asia, which is similar to our focus in the national program. The national program's outperformed that by just over 3%. Public equity markets in the US have had a strong run, and the national program is under the Russell 3000, which has been driven by large cap tech recently. And the national program is also below the Russell 2000, which focuses more on the smaller companies in the Russell 3000.
So with these performance differences, you can see how much of an outperformance over the last 10 years the U.S. markets, the Russell 3000, the Russell 2000, have had over the rest of the world to show that differential. And you know, as Richard said, this is to us the true measure. This is a public market equivalent where you're investing those dollars in the indices when that capital is called. And that's one of the unique parts of our asset class is when we make a commitment, all the money doesn't go to the manager in the beginning like it does with the public markets. It is called when they find investments that they want to invest in. So because of the sporadic nature, it takes longer for the fund to invest the full commitment. And that's why something like an IRR is a lot more appropriate as a performance measure than a time-weighted return.
Turning to page 154, and I'll conclude on this slide. This slide summarizes the strategy components. We have a $300 million to $400 million annual pace. We have $410 million closed in 2021. With the amount of distributions that we saw in Q4, we are evaluating the pace right now for 2022. The sub-strategies and geography targets were all within the ranges that we had. There's also no general partners above 10%, as we've had some realizations, so that concentration has come down, although we do have 2 managers that are currently above 9%, but the overall performance of those managers is 18% and 24%. On the fund series, there are 5 above 5% with performance ranging from 16% to 42%. And new managers are at 30 since 2011, as we've added some new managers in 2021. We are seeking some new relationships in 2022 of hard-to-access fund managers. With that, I'll conclude my remarks and happy to answer any questions the council may have.
Thank you, Richard. And actually, I'm going to go now back to the state treasurer and make sure that his questions were answered and see if he has any follow-up. All right, I don't hear anything from him, so we'll go to council for questions on the National Private Equity PMR.
Madam Chair, John Bingaman here.
Member Bingaman, yes.
And I'm not sure really who this question or sort of request is for, maybe more for RVK, but I'd love to see just sort of a peer comparison in terms of private equity allocation, you know, relative to some of our peers. I don't think we've really seen that, and I'd be very interested, you know, to see how we kind of stack up against other public plans. In terms of asset allocation, you know, we're at 13% today, and I'm just kind of curious where that sits relative to the universe.
Hey,
We
John,
can-
Madam Chair, it's Vince. John, yeah, RVK definitely get those numbers, and Marcia can let you know. The range is about 22, 23% at the top. So state of Washington, state of Oregon, Minnesota's up near 20, I think. Those states have about the highest allocation in public fund space. I would say, you know, the average is going to be around 10. Well, I guess let me say the median will be around 10. The average might be a little bit, maybe a point higher or something. So we're a little above average in terms of that weight. And but I know Marcia's got the statistics. She can show you, like, on a percentile basis where we sit.
We can get drilled down more on this. We show allocation versus peers, but the universe does not break out in alternatives. It doesn't break out private equity, but we're able to. We can get additional information for you.
Okay, thanks. I would appreciate that. And yeah, just as a comment, I mean, I think looking at the numbers on page 48, I mean, I think our program is doing quite well. If you look at 2011 and after, you know, sitting there at a 20% annualized return over the last 10 years. I mean, I think we have a lot to feel good about. So appreciate all the efforts.
I will say that if you look at the universe of the public plans greater than $1 billion, if the things that are lumped in alternatives, you're about median there. So, but we can try to get that drilled down more to be more specific to private equity. So.
Thank you.
All right. Additional questions before we move on to New Mexico? All right. Let's hear from the New Mexico Private Equity PMR. Back to Mr. Lee and Mercer.
Thank you, Madam Chair. I will just turn it over to Richard Pugmire to start going through the New Mexico third quarter PMR.
Thanks, David. I'll start on page 170 of the New Mexico program report. And similar to the national program, we'll start with a slide at the beginning to show the time horizon performance by the category of funds in the New Mexico program to give you a better sense of what's driving performance over different time horizons. It is a different quarterly story than the national program, as we did see negative performance during the quarter, which was contributed to by both the co-investment fund and the fund investments, while the recovery fund had a positive return in the quarter. When looking beyond the quarter, we have a positive contribution from the newer fund investments made in 2016 or after, which is still strong despite some decline during the quarter. The since inception for these funds is at a 27% net IRR and a $53 million gain. But it's important to note that these are largely unrealized gains at this stage, as we haven't seen the sizable realizations in the New Mexico program, because a lot of these investments are newer. So there'll likely be volatility in these numbers like we saw this quarter. The co-investment funds also have a sizable influence on both near-term and since inception performance due to their longer history and larger size. You can see over the last year that the co-investment funds are down 4%, and they have a since inception IRR of 0.8%, which contributes a gain of just over $20 million to the program. From a commitment activity perspective, we did do 4 commitments in 2021 for $35 million, and we have a pipeline of both new and re-up fund opportunities that we continue to evaluate for 2022.
Richard, I just wanted to interrupt.
Yeah.
And say, the prominent numbers on this page are the 37 and the 51%. And obviously, it says in the note that 2016 and after are separated because that was when we removed a requirement for a manager to open an office in New Mexico, which was of a big help in the process. But also, as Richard mentioned, these gains are largely unrealized and will remain so. One of the differences that we would note between the New Mexico program and the national program, this program is mostly venture capital. This is going to be the asset class that takes the longest to actually realize and distribute gains. The national program has a little bit of venture capital, but it also has a lot of buyout strategies and a lot of growth strategies. And that's why that capital tends to be returned quicker. And then the second thing I wanted to note is, when you see that 51%, probably a little bit of curiosity goes on. Right after the PMR is a summary performance sheet that shows by vintage year all of the funds in the New Mexico program. We have the same thing also for the national program. But so you can see what funds are encompassing that 51%.
Page 171 shows an overall look at the portfolio and the net asset value. The net asset value did decrease slightly by $9 million, which is driven by that portfolio loss that we had in the quarter. Year over year, though, we still have a gain. Since inception, net IRR increased from a 1% to 1.5% year over year, and then there was a slight increase as well in the net multiple, which is really driven by the newer fund commitments that we previously spoke about, and also the positive performance of the recovery fund as well. And you can see on this page the year-over-year change in fund investments is 2%. It goes from 2% to 3.8% for the active funds. The next page shows the breakdown of the net asset value changes in more detail, and I think this helps tell the story. In Q2, there was a $12 million gain and a large amount of contributions, which drove that net asset value increase to $512 million. In Q3, contributions and distributions were somewhat close, with contributions being $1 million more, but there was a $10 million loss, which caused that net asset value to decline to $502.7 million. Regarding cash flows, we in Q4 we also had a good quarter on distributions in the New Mexico program that was driven by the recovery fund, with about $17 million received in Q4, which increased the total 2021 distributions to $29 million. But contributions are still greater than distributions in this program. As for 2021, we have $55 million in contributions. The next page, page 173, goes into more detail on the quarterly activity. And you can see that the distributions in the lower left table there, the top two were from the recovery fund. And we did see even larger distributions in Q4 from the recovery fund. The gains and losses are really mixed, with the losses being more sizable during the quarter. And the losses were driven by declines in publicly traded companies. The first fund listed there had an IPO at a higher value than the previous valuation, which really influenced Q2 performance positively. But the stock price did drop in Q3, and although that fund is still a strong contributor to overall performance, it did cause a negative. It did contribute to the negative quarterly loss. Same with the co-investment funds, where there's a sizable exposure to a publicly traded company that traded down, and that was also a driver for the quarterly loss. On page
we have five investment fund tranches. Sorry to interrupt, Richard. We have 5 co-investment fund tranches. There's actually only one company that is public, but it is held in most of those tranches and accounting for a piece of those losses across the co-investment fund tranches.
Yeah, that's a great point. So page 174 is a slide that summarizes the economic impact. And, one of the themes that we've seen over the last year too is the recovery fund has really had a positive impact on these numbers and increasing these numbers. The portfolio is now at 112 New Mexico-based companies, with 25 being funded over the last 12 months. And then the total invested from the SIC is up to about $378 million. And at the fund level, it's at $494.5 million, with about $82 million invested over the last year. There's 5 companies no longer located in New Mexico, and companies who've received New Mexico government incentives, that number was reported as 25. On the next page, page 175, we also show job numbers and expenditures as another measure of economic impact. And the job numbers have really seen an increase. The jobs increased from 3,700 in the last report to over 4,000 in this report. And the job growth since inception has increased from 1,095 to 1,579 on this report. And a lot of this job growth has been coming from the hotel and leisure companies and the recovery fund. So it could be an economic indicator of future anticipated activities as we come out of the pandemic. And remember too, the recovery fund was targeting more mature companies that had more assets, whereas a lot of the venture capital funds that are in the portfolio, when they target a venture-backed company, there's not as many employees with that fund, at least initially, and we hope that it grows over time. There was also an increase in payroll numbers, up more than 20 million to 188.5 million, and then expenditures were also slightly up to 209 million. We have some other slides that go into detail of the portfolio composition in the New Mexico program, but I'll end there and happy to answer any questions that the council has.
Great, thank you, Richard. Questions from council? Okay, hearing none, we're going to move to our investment votes. This is agenda item 3 of our agenda, and I'll turn it first over to the chair of the CIC, Member Lavender.
Hi, everyone. You know what? I'm gonna. All of these various investments were discussed at length by the council, by the committee, and I think that I'd like to once again encourage council attendance at the investment committee meetings if possible, because we go into much more depth there than we have the opportunity to do here. Having said that, I will apologize to the council. You're going to hear my voice a whole bunch as we go through these 6 investments. But having prepared you for that, let's turn it over to the David Lee and Mercer for 3B.
And just to be clear, Member Lavender, all of these investments were approved by the investment committee.
Yeah, the investment committee recommended approval of each of these investments unanimously.
Very good. Mr. Lee.
Thank you, Madam Chair. Thank you, Member Lavender. This is David Lee, Private Equity Director. I'm joined by Chris Cassidy, Richard Pugmire, and Amy Ridge, and also Bob Weaver, Managing Director, and Dan Tortora, Vice President of Advent. I'll provide some summary comments for the materials that start on page 196, and then turn it over to Mercer and the manager for further comments. GPE-10 is a control-oriented global buyout strategy. This is mainly in North America and Europe that they'll be investing. For the last 5 funds, Funds 5 through 9, about 50% of the investments were in Europe, 42% were in North America, and 8% in Asia and Latin America. We expect Fund 10 to have 35 to 40 investments with a range of 100 million to 2 billion in terms of check size. And that wide range does demonstrate an agnostic attitude towards size. They have 5 core sectors: industrials, which has accounted for 25% of the cost for the last 5 funds, retail, consumer, and leisure, 21%, business and financial services, 20%, healthcare, 19%, and technology, 15%. Fund 10 will have a $23 billion target. Fund 9 was 17.5, and Fund 8 was 13 billion. The GP commitment here will be at least 700 million. And then in terms of the history of Advent, Advent was founded in 1984 by Peter Brook, who was the co-founder of TA, another one of our excellent managers, and has been operating across multiple continents since 1989. Staff and consultant consider their large global footprint and network to be strong competitive advantage versus their peers. Advent has 256 investment professionals working in 14 offices in 12 different countries. This doesn't include over 280 operating partners, advisors, and industry advisors. On the GPE fund series, there's 190 investment professionals and 30 portfolio support group professionals that are dedicated to that platform. In addition, Advent has roughly 36,000 companies in its database that it tracks, but it utilizes its 50 to 60 sourcing cells to identify highly attractive subsectors and companies. Performance has been consistently strong for the last 5 funds, mostly first quartile on a net multiple and first or second quartile on a net IRR basis versus the Burgess Global Buyout Universe. Distributions to paid-in capital, or DPI, is first or second quartile for funds 5 to 9. Breakout potential, which is a very important part of how Advent underwrites, 28% of the invested capital in funds 5 through 9 is currently marked above a 3.0 gross multiple. That, combined with a historical loss ratio of less than 10%, goes a long way to explain this stellar performance. We continue to believe that Advent is an excellent long-term partner. Fund 9 is off to a fast start and is already greater than 2.5 times net multiple. And this would be our second commitment to the Advent funds. We did commit 50 million to Advent GPE 9. And staff and consultants are recommending a commitment of up to 75 million for Advent GPE 10. That concludes my remarks, and let me turn it over to Amy Rich for additional comments.
Great, thank you, David, and good morning to everyone. As David just said, this is a re-up opportunity for you with a really strong manager. Advent was founded almost 4 decades ago, and today is one of the largest global private equity firms in the market. The firm has a buyout focus and a global approach. They expect to invest 40 to 45% in each of Europe and North America, and then the remaining 10 to 20% in Asia and Latin America. The team is large. They include almost 200 investment professionals. And then you have the 35% operations group who help drive actual operational value enhancements after the investment is made. And we also like their boots on the ground. With a global investment approach, they have 14 offices in 12 countries. Performance has been really strong, largely first and second quartile returns, including first quartile performance by all metrics, including net IRR, TVPI, and DPI for Fund 9, which is the fund that you are in. So overall, we really like their global approach, their large and experienced senior team, their opportunistic approach to investing where they can invest across geographies, sectors, and investment sizes. and their long and consistent track record. A couple of areas of consideration, they don't include a preferred return. And this is more common in venture and growth equity funds, but most buyout funds have an 8% preferred return. However, we do see this in the older private equity firms such as Advent. They've never included this, but they do include a fair market value test. And this does help protect from Advent taking carry if the fund is underperforming. And then the other factor is just the fund size growth. We're seeing it across the market. Fund 10 will be about 40% larger. They are expected to reach their hard cap than the previous fund. But we did spend a lot of time with them, and we don't think that this fund size increase will change the strategy that they have deployed so successfully before. So overall, we are recommending up to a $75 million commitment to Advent International Fund 10. And with that, I will now turn it over to Managing Partner Bob Weaver and Vice President Dan Tortora from Advent.
Amy, thank you very much. And thank you, Madam Chair, Commissioner, and council members. My name is Bob Weaver. I'm a partner at Advent in our New York City office. Speaking to you today from Darien, Connecticut. We are happily going to be reopening our office next week, so back to work soon. I want to thank Mr. Lee and Ms. Ridge for a really fulsome overview of the fund, of the firm, and I'm going to keep my comments relatively brief and try not to be redundant to the comments that they've made already. First of all, a thank you for committing in your participation in GP9, which was correctly noted as a $50 million commitment in our 2019 vintage fund. We are targeting a $23 billion raise, and it was correctly noted that our hard cap is $25 billion. We do expect to hit that hard cap, but nothing is done until it's all closed. But the fundraising and investor demand has been strong. Maybe a couple of comments to try and shed some light on some things that were noted. Something that is very core to Advent's investment philosophy is trying to identify businesses to purchase where we can impact those businesses to really achieve breakout potential. And we define breakout as being able to deliver 3 times or more net money on the investment. And to the extent that we're able to identify several of those sort of opportunities in each fund, it does put us in a strong position, all things being equal, including relatively low loss ratio, of being able to get into top quartile and top decile performance for those funds. It hasn't happened in every single fund, but it was correctly noted that our track record is quite good and has been improving. In Fund 9, which is your investment, we currently have 4 investments that are marked over 3 times, including one which is over 15 times money and one that is over 6 times money. So the ability to buy businesses, impact them profoundly from an operational perspective, to accelerate growth or to fundamentally transform businesses is something that we take a great deal of pride in, put a lot of effort into, and happily have been yielding results. From an asset allocation perspective, to shed a bit more light on the geographic and sector diversification, it was correctly noted that we are roughly evenly split between North America and Europe, with up to 15% of the fund that can be invested in other parts of the world. And for us, that principally means Asia. Within each of those geographies, we have 5 sectors of particular focus, including industrial, tech, healthcare, retail and consumer, and business and financial services. And we don't have buckets per se for any particular geography or any particular sector, but we do have boots on the ground in each sector and in each geography. And from an investment committee perspective, our decisions are made locally with regional investment committees in North America, Europe, Asia, Latin America, and one
sector-specific investment committee, which is in technology, just given the particularities of that particular sector. The firm is owned exclusively by the 57 partners of the firm. We're governed by 14 managing partners of the firm, and it's that managing partner group that makes decisions on behalf of the firm. So we don't, interestingly, have a CEO or a president. It's a consensus-based organization that is highly collaborative, and decisions from a firm perspective are made by that group. So let me pause there just for a moment. I want to give you just a quick update on your performance in Fund 9. From a realization perspective across our funds, we realized $23 billion of investments in 2021, which is 3 times our prior high watermark. And I mentioned that because earlier in the conversation today, your consultants and staff noted $1 billion of distributions for the State Investment Council, which was your high. I just wanted to share our facts because it's very much in line with the robust capital markets and buying market and overall liquidity last year. So it was a rich year in realizations. Your commitment in Fund 9 is performing well. As of 12/31 of last year, GP9 had made 29 investments with $10.6 billion of cost. That's currently marked at 2.9 times net multiple of money. So whereas it's early days in that portfolio, I think it would be fair to say that it's off to a very strong start. And we are delighted and thankful, for the opportunity to have you consider a commitment of up to $75 million in Fund 10. So with that, David and Amy, I'll pause and take your lead, please.
Very good. Thank you, Mr. Weaver. Okay, we're going to go to questions from the council for either the consultants at Mercer, Mr. Lee, or the representatives from Advent. Questions from council? All right, hearing none, I'm going to ask Andy to take a roll. Sorry, I'm going to ask for a motion.
Yeah, you got it. Madam Chair, this was another one of the strong private equity investment possibilities. Based on the recommendation of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff in general, produced the area oversight of RVK. I move the State Investment Council approve commitment of up to $75 million to Advent Global Equity 10, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, that is a proper motion. Do we have a second?
A second, Nick.
Okay, we've got a motion by Member Lavender, a second by Member Tejas. Do we have any discussion on the motion? Now I will have Andy take a roll call vote on the motion to approve the Advent investment for $75 million.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes unanimously.
Okay, great. And we thank the representatives from Advent for being on. Thank you very much. We'll go next to agenda item BC, another private equity vote, CRB 14, and CRB 19, and I'll turn it over to Mr. Lee.
Thank you again, Madam Chair. Again, I'm joined by Chris, Richard, and Amy. And we have also joining us John Auerbach, General Partner for CRV. I'll make some introductory comments on CRV, which the materials start on page 270. If it's okay, I will talk about, even though they're separate votes, I'll talk about Fund 19 and Select 2 together, it's a little bit easier to understand. And not only is it the same firm, but it is the same team that manages both funds. So CRV is an established, high-quality venture capital firm that was founded in 1970, and they built a strong reputation as an expert in its focus areas of software and some other technology. The fund strategy for Fund 19 will focus on early stage and seed stage venture capital investments. 75% to 85% would be in seed and Series A, and the rest would be in Series B. And this is predominantly in North American-based software and technology companies. The select funds will target existing CRV companies that are raising later stage rounds or other later stage companies. And by that, we mean mainly Series C or later. Fund 19 has a target of 25 to 35 companies in the fund in seed Series A and high conviction Series B. And Select 2 will target 15 to 20 companies. The target size of Fund 19 is $900 million. That's compared to the $600 million in Fund 18. And Select 2 will target $600 million, which has gone up from $200 million in Select 1. The general partner commitment, which would be funded in cash, has a minimum of 1%, but in the previous fund, the GP commit was roughly 3.3%. Fund 19 will average check sizes of $15 to $25 million over multiple financing rounds, seeking 15 to 25% ownership. Select 2 will average $30 million to $40 million per investment. CRV has developed an extensive network of relationships, about 11,000 executives in the Bay Area, which it utilizes for investment sourcing, for recruiting, and also for providing strategic advice to its portfolio companies. The firm also has a long history of venture capital, and understandably, its funds are very difficult to access. Performance for the last 5 funds, excluding the 2020-2021 funds, because they're so recent, so that would be funds 13 to 17, has been strong, with 4 of the 5 funds ranking in the first or second quartile versus the Burgess North America Venture Capital universe for net IRR, TVPI, and DPI. Fund 14 was the only one that wasn't. That's a 2009 vintage, and that was ranked in the third quartile. Staff and consultants are recommending a commitment of up to $35 million in Fund 19 and up to $25 million in Select 2. These 2 funds would be the first 2 funds to CRV. That concludes my remarks, and I will turn it over to Richard Pugmire of Mercy.
Thanks, David. We're excited to be presenting CRV to the council today. We consider CRV one of the premier venture capital firms in the industry, and we're targeting $35 million in CRV 19, which is focused on early stage venture capital, and $25 million in CRV Select 2, which is focused on later stage investments in CRV portfolio companies. CRV has one of the longest histories of any venture capital firm, with over 50 years of history. You can see it by the firm being on Fund 19. Besides being successful investors, one of the contributors to their success over the years is really focusing on developing that next generation of investors. They focus on promoting from within and finding a way to transition economics from its funds to the next generation, which we believe will positively contribute to CRV's future performance. The strategy focuses on software and technology, mostly in the enterprise space, that has the potential of being disruptive and generating outsized returns. Their consistency and focus in pursuing this strategy led to a lot of advantages, including in sourcing new investments and also utilizing its network to help portfolio companies with marketing and recruiting. Finding talent and making introductions to industry players has become one of the most important value adds that a manager can provide a company, and CRV definitely has an advantage in that area. On the performance front, CRV has multiple funds in the top quartile. And when you look in the fund, the drivers of performance, there are multiple companies that are producing outsized returns, typically greater than 5 times and even 10 times invested capital. The Select Fund is a newer initiative for them, focusing on later stage investments in CRV portfolio companies. On the consideration side, we have spoken about fund terms with some of our past recommendations. The fundraising market's strong right now due to the performance seen in the industry. And one of the balances that we have to look at is fund terms compared to the quality of team, the strategy's attraction, and the strength of the track record. It's often the case where the higher quality firms with a strong track record have some manager-friendly terms. And the CRV funds have some manager-friendly terms, but there are several things that we like about the terms, like a meaningful manager commitment. We're also focused on net of fees performance and feel CRV is a strong firm to include in the national program. The other notable characteristic of CRV is their fund size discipline over time. So often in this industry, we see successful firms increase their fund size, sometimes quite significantly. And CRV has stayed relatively disciplined, which has made it hard for new investors to get access. But with funding rounds and venture capital having increased over the last few years, that's prompted an increase in fund size and created an opportunity for the SIC to get access to this manager. We're excited about potentially adding CRV as a new manager in the national program. And I want to introduce John Auerbach, who is the managing general partner at CRV, and he's been with the firm since 2007. John will give a short presentation, and then we'd be happy to answer any questions that the council has.
Thanks so much, Richard, David, and Chris. Madam Chair, distinguished members of the council, my name is John Auerbach. I'm one of the 5 managing general partners at CRV. I will keep my remarks brief as well. There is a term in psychology, for those of you who've studied it, called illusory superiority, which briefly means that people generally are not as good as they think they are. The classic example would be 95% of Stanford undergrads think they're in the top 50% of Stanford undergrads. And in venture capital, it's 100% of venture capitalists believe that they are in the top decile, which is ironic because it's a highly measurable industry. The only way we are differentiated at CRV is we have 52 years of practice of early stage venture capital and thus 52 years of data. And that really guides us to be humble, to be hardworking, to be ethical at all times, and to essentially buy ownership at the earliest stage in a portfolio of companies, knowing that in early stage venture capital, some, or in some cases many, will fail. But if we pick a market basket of exciting software companies, it can drive exciting returns for the firm. CRV began its history as Charles River Ventures, based in Boston, Massachusetts, actually Cambridge, outside of MIT. And over the last 20 years has migrated the firm fully to the Bay Area. Fund 19 and Select 2 will be the first in our history where the entire team is based out here in the Bay Area, because we believe very strongly that early stage venture is a team sport. And the underpinnings of that sport are trust and conviction within the partnership. As Richard said, we are a firm that has focused for the last 30 plus years over nurturing the next generation and turning over the partnership multiple times. Generational transfer can be a very tricky issue in our business, and we feel like we've cracked that code as much as any firm out there. And finally, I'll say we have a luxury as a 52-year-old firm with relatively good performance across each of those decades that we get to choose our limited partners. As Richard said up front, this is a larger fund than the last, although we hope that the markets will not stay this way forever and that we can get back to the business of lower valuations and smaller check sizes. But we do get to choose our limited partners. It has been such a great pleasure to get to know Chris and David and the team and work with Mercer on an exciting partnership that we believe, if we're doing our job, can last many, many years. We have an exciting base of limited partners that includes some of the country's best endowments and foundations, fund of funds, and private pensions. And we're very excited to partner with the state of New Mexico and do the good work that we hope we continue to do. Finally, I will say New Mexico is near and dear to my heart, in particular my sister and brother-in-law, who worked for the state for several years, spent a long time in Santa Fe, and hopefully that will give this investment and their connection with Santa Fe will give us more reason when COVID ends to visit and get to know you all. With that, I'll stop and answer any questions you might have.
Thank you, Mr. Auerbach. And actually, in looking at the fund terms, I think this question goes to Mercer. On page 4 of the Mercer report, or 279 of our materials, why is the target gross net IRR, it says not stated, and I just wanted to know if that's typical?
Yeah, with venture capital, it's hard to know what the hold period is going to be because you're investing in these companies at an early stage. So the fund is targeting a 3x net return. But if we have a strong capital market like we're in right now, hold periods could be shorter, and you could end up having the higher net IRRs like we're seeing right now with venture capital investments. But it is possible that hold periods could be longer. I mean, up to 9 or 10 years for a company to really kind of become a breakout multi-billion-dollar company. So that's why there really isn't kind of a target net IRR.
So there's not even sort of I guess a range stated for that? You just kind of leave it blank?
Yeah, John, I don't know if you have a target net IRR that you...
Yeah, it's a great question. I'll try to answer it very briefly. We are a cash-on-cash oriented firm. In terms of how we think of it, that 3x net, if you look at our funds, I'll just give you gross numbers that are updated. We're running between 7 and 9x on our funds in 2012 and 2015, 4x on our fund in our fund 17. I would say if you just look at where the latest Cambridge numbers are, I'm just pulling them up right now, apologies. We are, as of Q3, running at 37% net IRR for our 2015 fund and 31% for our 2012 fund. Please don't pay attention to the 2018 fund. That's at 60+% net IRR. But as we see in the J curve early on, you'll see that kind of performance. And then most of our funds you should expect to be in the 20 to 35% net IRR range.
Yeah, so I appreciate having a little bit of a range rather than just a blank spot there. So I appreciate that answer. Thank you. So with that, we'll go to council questions for any of these folks, either our staff, Mercer, or the representatives from CRB. And once again, these were presented together, but we are actually going to take two separate votes. The first one for the $35 million investment to Fund 19, and then for the $25 million investment to CRB Select 2. Questions from council? Do we have a motion?
Thank you, Madam Chair. This was another, I think, really appreciate the fact that this was brought to us. I think this is a great opportunity to continue. Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move the State Investment Council approve a commitment of up to $35 million to CRB 19, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, next.
Okay, we've got a motion by Member Lavender, a second by Member Tejas. Any discussion on the motion? If I could have Andy take a roll call vote on a up to $35 million commitment to CRB Fund 19, please.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, that motion unanimously passes.
Very good. Next, we'll go to the $25 million commitment to CRV Select 2. Do we have a motion? Member Lavender?
I'm sorry, Madam Chair, my computer shut down, but I'm back again. Based on the recommendation of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $25 million to CRV Select 2, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second that, Nick.
Okay, we've got a motion by Member Lavender, a second by Member Tejas. Any discussion on the motion? We'll have Andy take a roll call vote on an up to $25 million commitment to CRV Select 2.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes unanimously.
Very good, and we appreciate having on the line Mr. Auerbach from CRV, and look forward to meeting you sometime in the future. Thank you.
Thank you all.
All right, let's move on to our real estate investment recommendations. This is agenda item 3E for Blackstone Real Estate Partners Asia 3, and I'll turn it over to Mr. Sable and our consultants from Townsend.
Good morning, Madam Chairman. Again, this is Keith Sable speaking, and we're talking about Blackstone Real Estate Partners Asia 3. The content for this portion of the presentation begins on page 342 of your materials. Staff, in consultation with Townsend, recommend a commitment of up to $75 million to Blackstone Real Estate Partners Asia 3 for the SIC's real estate allocation. Blackstone is expecting to raise approximately $7 billion for this fund. Joining Seth and me this morning from Blackstone will be Alan Miyazaki. He's the Senior Managing Director and Head of Real Estate Acquisitions Asia for Blackstone. Also participating for Blackstone, Gary Lynn and Paris Taylor. Blackstone Real Estate Partners Asia 3 is a closed-end commingled fund targeting gross returns of 20%, that's 15% net, utilizing 55 to 65% leverage. Blackstone's a thematic investor, and the primary themes targeted in this fund are logistics, tech office, rental housing, particularly in Japan, and tourism and hospitality. The SIC's relationship with Blackstone Real Estate Funds dates back to 2012 and includes 3 commitments to their flagship Global Opportunistic Fund Series, also to Blackstone Life Sciences, the European Opportunistic Fund, and a predecessor to BREP Asia 3. In all, we have more than $232 million in Blackstone real estate funds. Blackstone is also represented in the real assets portfolio with approximately $150 million invested across 3 funds and a co-investment vehicle. The since inception's return have been strong across the entire real estate platform. Per the 2021 structure study, New Mexico SIC is targeting the 5% to 15% band for exposure in Asia. Our current weighting is approximately 6%. Most of SIC's Asia exposure is through an Invesco core fund with additional contributions to that exposure from Blackstone Asia and Blackstone's global flagship funds. As Blackstone Asia 1 liquidates, the 6% exposure to Asia will necessarily decline unless replaced with new commitments, such as the one that we're recommending today. At this point, I'll hand it over to Seth to present Townsend's underwriting.
Thanks, Keith, and good morning, everyone. Again, before talking directly about Blackstone, maybe I'll just touch on the real estate allocation. So like we have in the past, we have 2 investments in front of you this month. Individually, the cover memos highlight the portfolio fit for the individual investments and also include a section in the back highlighting estate portfolio construction if both investments are approved. Before getting into the investments, as I discussed in prior months, our Townsend investment pacing model for the calendar year 2022 originally called for approximately $300 billion in new non-core commitments. And this is to maintain our 55% core, 45% non-core exposure, as well as reaching a 12% real estate allocation, all while maintaining vintage year diversification. However, as we've stated in the past, commitments can be accelerated or decelerated based on the quality of the opportunity set, the market environment, core versus non-core weightings. And we will be updating the model when we have year-end performance and anticipate really another year of over-commitments this year, given the volume of strong follow-on investment opportunities available to us under the current allocation within real estate. So both of the managers in front of you today, Blackstone and EQT Exeter, are follow-on investment managers that we are excited to present to you and continue to be a good piece of the portfolio and a strong outperformance. So thus far, we have approved $275 million of commitments to non-core. If both proposed investments are approved today, we'll be at $425 million. Based on this overcommitment and then some additional commitments that we do anticipate coming in future months to really other high caliber existing managers, we don't believe that or anticipate these commitments to cause any allocation or compliance concerns for the real estate portfolio. So now that I've gotten that out of the way, getting into the specific investment, as mentioned, we're recommending $75 million commitment here to Blackstone Real Estate Partners Asia 3. This is a follow-on commitment, although we did skip Fund 2. We are invested in Blackstone Asia 1. Keith went through the exposure we have to Blackstone, and just to put some context around that, it's a number of commitments, obviously, but Blackstone real estate exposure specifically would be about 9.3% if we approve this commitment today, and that's on a funded and committed basis. So that's on a static basis. Obviously, managers are calling and distributing capital regularly. This is well below our 35% limit and what we believe in the confines of sort of a diversified portfolio well within the range we're looking for. As mentioned in the materials, this is Blackstone's third dedicated Asia Pacific fundraise. However, their track record dates back well before this series, really through the investments in the diversified fund, which we do have exposure to, but their track record really dates back to the 90s. Keith went through the target returns and the size of the fund, so I'll skip some of those comments. I do think that it's necessary to maybe give a little bit of a Blackstone background for those just to recall. It's one of the world's largest investment firms, traded on the New York Stock Exchange, A+ rated by both S&P and Fitch. It was founded in 1985, currently invests across alternative asset classes, including real estate, private equity, credit, hedge funds, and others. Total assets under management is over $640 billion. And then Blackstone established its real estate portfolio really in 1991, and it's now the largest real estate investment manager with over $196 billion in investor capital under management. This spans across opportunistic, core plus, and debt. Blackstone Real Estate Partners operates around the globe with over 590 dedicated professionals, 10 offices across North America, Europe, and the Asia Pacific region. This specific fund plans to extend upon the strategy of its predecessor funds to construct a diversified portfolio of real estate assets in the Asia Pacific region, really with a focus on those core Asia Pacific countries outlined in our materials. It also plans to really focus on the themes that Blackstone really has a high conviction in. This includes logistics, underpinned by the blooming e-commerce market, IT or tech office, supported by technological transformation in the entire Asia Pacific region, and then rental housing in supply-constrained markets such as Tokyo, where really young professionals continue to prioritize living nearby city center. And then lastly, tourism and hospitality, driven by anticipated recovery post-COVID, but also the rising middle class of Asia and a shift towards consumer preference on spending on experiential spending of the discretionary capital. The fund has an active pipeline. It exceeds $1 billion. I'm sure the Blackstone team will talk a little bit about that, but the initial transactions include all of the themes that I just mentioned. As always, in our materials, we highlight a number of competitive advantages and potential risks I went through some of these in detail on the CIC call, so I'll admit that commentary today. And maybe with that said, I'll just pass it along to the Blackstone team for their presentation.
Thank you very much. I really appreciate you guys having us today. My name is Alan Miyazaki. I oversee acquisitions throughout Asia for our real estate business. I've been at the firm 21 years and have spent the last 15 years based in Asia. And today I'm talking to you from Singapore, which unfortunately it's 2 a.m, but that just gives you a sense of how dedicated we are to the partnership here. One thing I would talk about quickly about Asia is one thing that we really see in the U.S. and we've seen in Europe over the last year is there's been a great reopening trade as things have started to reopen from COVID. You've seen that represent in equity markets. You've seen that in travel markets as everything is open and people have gotten out and been able to actually spend money. That largely hasn't happened in Asia yet. Singapore is probably one of the more open markets in terms of being able to travel. Australia is trying to open in the next couple of weeks, but a lot of the markets, the Japanese, the Korean, Hong Kong, China, all basically remain closed. So in Asia, we haven't really experienced that reopening trade yet. And I think one of the opportunities for this fund is to really invest in some of these markets prior to that reopening and before you get some of that lift. And I'll talk about that specifically in things like hospitality in a couple of minutes. Secondly, Blackstone has a large global platform, and that's no different here in Asia. We have about 130 professionals across 7 offices, which makes us by far one of the largest by headcount and by AUM managers in Asia. Our portfolio in Asia is about $60 billion of enterprise value. And the reason why that's important is Asia is largely not very transparent. So, in America, if you want to understand what's going on in a market, you can go to a broker and talk to them, and they'll have just about perfect information on every lease and every building in their home market. But because Asia is not very transparent, it's very difficult to assemble information. And one of our advantages is being able to actually data mine from our own portfolio. So, for example, if you want to buy a logistics asset, leasing one down the street is a great advantage because you know exactly who's in the market, who needs space, what rents they're willing to pay. And that really helps you identify opportunities, both on the acquisition and disposition side. A good example of that, we recently bought a warehouse in Sydney. And the reason why was we literally owned a warehouse 2 kilometers down the street and had a 30% releasing spread because there was so much demand. That helped us set or have a better understanding of what market rents were, and we're able to buy other warehouses before everybody else in the market figured that out. So I think that the scale of the platform and the scale of the people is very important. The people, especially during COVID, because of all these restrictions on travel, became very important to be able to execute, underwrite, finance, and asset manage assets. So in a lot of cases, groups were not able to buy things or do deals because the boss who lived in Hong Kong or London or Tokyo was not able to travel and see the asset or meet the counterparty. But for us, having people in the market on the ground that could actually transact was a huge advantage. And it meant there was probably less competition because less people could actually get things done. The last thing I'll talk about quickly is our themes. And I know our thematic investing strategy was mentioned earlier. That's always been a big focus for us. Industrial is probably Blackstone's biggest theme globally, really predicated on the rise of e-commerce. Though in some parts of Asia, it's lagged the U.S. and Europe. It's a very big trend. We are still continuing to see growth there. And we're doing not just the big warehouses, we're also doing last mile logistics in places like Australia and New Zealand. Multifamily, which is predominantly Japan, but also growing in places like Australia and Shanghai, that's really a play on the growth of housing prices have made housing, unfortunately, less and less affordable for many people in these places. And so there's a growing need for rental housing, and we're able to provide that in a high quality manner. So we're continuing to grow that business. Office, this is really predicated on job growth. So increasingly, we look to tech companies and look at where tech companies are hiring because they tend to be one of the bigger drivers of hiring and what neighborhoods they want to be in. So if you went to Tokyo, it's not necessarily
heart of Marinucci, which is the CBD, it may be in Shibuya, where most of the tech companies are. Or if you go to Seoul and Gangnam, where the tech companies want to locate as well. We're really trying to make sure that we're buying in locations where people want to be and where there's job growth. So if you were to, we do this all via tech now, but if you went and said, 20 years ago, if you opened the Sunday paper and looked for all the help wanted ads and tried to figure out where each job was located, that's essentially what we're doing through data analysis and figuring out where jobs are being created to make sure we're buying office buildings in those types of locations. And in addition to that, making sure we're putting in the right amenities that these tenants want and their employees want. And increasingly, as there's a push to return to the office, we think that having high quality amenities, be that gyms, coffee shops, facilities where if you want to ride your bike to work, you can park your bike and take a shower. Those things will be increasingly important as companies try to help get their teams and their people back to work. And the last theme is hospitality, which honestly, if you looked at your investment in Fund 1, was not as big a theme for us. We hadn't done as much hospitality in Asia, but we have seen a great opportunity through COVID, as many of these hospitality assets have been a bit more challenged. It's been an opportunity to bring in Blackstone's expertise in management to really aid these properties and really put them back in a path to being great again. And we do see that there's an opportunity with the rebound in travel. We're already seeing it. We actually have in Fund 2, we have 2 hospitality assets in the Maldives. And even though most of Asia is not open yet, we are seeing international travel from Europe and 1 or 2 places in Asia. And we've seen immense demand, and that's really, really helping the performance there. So I think that as Asia reopens, you'll see more and more desire for hospitality and more desire to travel. And we're looking to play on that theme through the hospitality angle. With that, I will open up if there are any questions.
Thank you, Mr. Miyazaki, and we appreciate your commitment to being on at 2 a.m. So let's go to questions. Yes, we'll go to questions from council for either Mr. Sable, our representatives from Townsend, or the representative from Blackstone. All right. Hearing none, do we have a motion?
Madam Chair, this is Harold. This was another unanimous approval by the Investment Committee recommendation. Based on the recommendations of the Council Investment Committee, advisor of the Townsend Group, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $75 million to Blackstone Real Estate Partners Asia 3, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second it, Nick.
Okay, we've got a motion from Member Lavender, a second from Member Tejas. Any discussion on the motion? Okay, if we could have Andy take a roll call vote, please.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion passes unanimously.
Very good, and we appreciate Mr. Miyazaki for being on. Thank you, sir.
Thank you.
Okay, well, let's move on to our next real estate investment recommendation, agenda item 3F for Exeter, and we're going to turn it over to Mr. Sable and our consultants from Townsend.
Madam Chair, item 3F is a recommendation of an investment allocation of up to $100 million to the EQT Equity Industrial Core Plus Fund. Exeter is targeting a $2.5 billion raise for this portfolio. Joining Seth and me will be Gardner Elner, a principal and portfolio manager for the U.S. Industrial Core Plus portfolio, and Rand Chen, partner and head of investor relations and reporting. The Core Plus Fund is a dedicated industrial strategy focused on acquiring stabilized assets and holding for cash flow while marking rents to market
on lease expiration. As Exeter has done in past funds, they expect to earn a premium return by aggregating assets and achieving a portfolio premium when they are sold. Exeter expects to deliver net returns in the 8.5% to 10% range, utilizing 50% leverage. SIC's relationship with Exeter is a long one dating back to 2014. As of the third quarter of 2021, SIC was invested in 5 Exeter funds, including a current net asset value, that is, of $233 million. However, during the fourth quarter, those investments distributed more than $200 million from 2 large portfolio sales. For the 3 U.S.-focused funds, Exeter Industrial Value Funds 3, 4, and 5, since inception, returns have been very robust at 30.9%, 31.2%, and 23.3%, respectively. All of the assets in Funds 3 and 4 were liquidated in a portfolio sale at the end of last year at valuations above the 3Q marks, returning approximately $92 million in capital to SIC. Similarly, our commitments to the European Value Venture 3 were sold in the fourth quarter of 2021, generating a net since inception return of 57.9%. These large portfolio sales demonstrate Exeter's strategy of buying by the can and selling by the case. Such portfolio sales have allowed Exeter to realize a substantial premium on the liquidation of these portfolios. Our strategy overall is to be overweight industrial relative to the Odyssey benchmark. The portfolio sales mentioned above will cut into that 10% current active overweight that you'll find in the Townsend PMR. The commitment to the Exeter Core Plus Fund 4 will help maintain the intended overweight while reducing risk by moving assets from value add into Core Plus. With that, I will wrap up my comments and hand off to Seth.
Thanks, Keith. I'll again just briefly provide a background on our existing exposure. I know Keith did as well, but the Exeter name is one that we know and have invested with throughout their U.S. dedicated industrial series through 3 funds, totaling $175 million, and then in Europe through 2 funds, totaling $175 there as well. We actually do have exposure, or did have exposure to their Fund 2 in the U.S. through an emerging manager fund-to-fund period that is since liquidated. But our history with Exeter goes back quite a bit. Each of the funds has performed well and is why we are seeking an additional commitment here to Core Plus Fund 4. Similar to the comments I made on Blackstone, this does seem to be, quite a lot of exposure to a single manager. However, as noted in our memo, it's just about 8.4% of the real estate portfolio, well within our limits and well within our comfort level. Further, Exeter has a very strong track record, as Keith mentioned, realizing and distributing capital back to investors upon sort of a lump sum exit versus a deal by deal sale. So we are seeing that allocation change pretty significantly over time. I walked through the pacing already, so I'll jump into the fund. As outlined and as Keith mentioned, Exeter is seeking a $2.5 billion fund for this Core Plus Fund 4. The fund targets 8.5% to 10% net IRR, 50% leverage, and a 12-year fund life. The funds focus on core plus warehouse, light industrial real estate investments across the U.S. Specifically, the fund will acquire really well-occupied Class A distribution assets generating a 5% yield on average, or 6 to 7% cash-on-cash yield at about 50% leverage. The target markets focus on really major population centers, distribution hubs across all regions in the U.S. And the business plan is primarily focused on driving value through releasing or renewing existing tenants at higher rates, and then holding for current income and distributions while aggregating a portfolio exit. That exit strategy is key to the success of Exeter, as we've mentioned a couple times now, and has been proven over the course of their investment history. To this point, when you look at the track record for the Core Plus funds, the first two funds, which were more club vehicles, you'll notice Fund 1 was fully realized. This was through a portfolio exit, significantly outperforming its target returns of 8 to 10, delivering a 22% net return. No realizations have occurred in Funds 2 or 3, given the planned exit through a portfolio sale, but Exeter has been approached in each of these funds to sell and is evaluating those opportunities. As Keith mentioned again, we are positioned overweight to industrial, given the strong demand fundamentals driven by e-commerce over the last 10 years, and really accelerated over the last couple of years of COVID. Our portfolio has a 36% allocation to industrial. However, even after this commitment, that exposure is anticipated to decrease, given the recent commitments focused on other sectors, multifamily or diversified commitments, as well as portfolio sales, as mentioned from the Exeter exposure. For these reasons, we are recommending this commitment to maintain an overweight. It will likely be back in later this year with a follow-on industrial exposure. Both the comparative advantages and potential risks, again, are outlined in our materials. I went into details on these at the CIC. Unless there's any questions, I won't go into too much more than that at this point. And I will hand it over to the Exeter team for their presentation.
Great. Thank you so much, Seth. Good morning. My name is Rayanne Chen, and I was one of the founding partners of Exeter about 16 years ago, and I'm the head of investor relations. EQT Exeter is a real estate division of EQT, which is the global private capital firm. And our 300-person real estate team is made up of specialists who focus on a particular geography and a particular property sector, whether it's industrial, office, life science, or multifamily. So today, of course, we're here to talk about our U.S. Industrial Core Plus Fund. EQT Exeter has approached real estate investing with 4 fundamental principles that are rooted in our team's history, which goes back decades together. They entail highly local presence, in-house leasing and tenant relationships. These are relationships that we hold directly. In-house design and development skills, and the prolific sourcing of single asset acquisition opportunities. And that's a high volume, hard work, elbow grease part of the market that EQT Exeter dominates. EQT Exeter also differentiates the sector by a decade and a half of exceptional returns. So thankfully, Keith and my thunder here, but I will say, all 7 of our industrial value funds, whether in the U.S. or Europe, have been benchmarked as the top 5% of their peers across all geographies and all property sectors. We're excited that today you're considering an investment in an additional Exeter Industrial Fund series, given that you have already invested in our value funds in the U.S. and Europe. The U.S. Core Plus funds have also been strong outperformers, exceeding their original targets in the Odyssey Overnight Core Fund benchmarks. So Gardner Elner will take over the phone line to explain how we do it.
Good morning. Thank you, Rayanne. My name is Gardner Elner. I'm a co-portfolio manager for EQT Exeter Industrial Core Plus Fund 4. The fund's objective is to provide stable income and growth in capital value. We accomplish this first part, income, by acquiring assets that are essentially fully leased. The long duration of the in-place, the quality of the tenant credit help protect the stability of these cash flows. We seek to achieve the second component, value growth, by acquiring highly functional assets in the top 25 markets at discounted cost. To us, this means costs are at or below replacement cost. We also look for the ability to increase rents to market, as well as the opportunity for strong future rent growth. Given our long heritage as an active manager of industrial properties, we excel at creating value through leasing and driving rental rate growth. This is because we understand the needs of our tenants, we focus on tenant retention, and truly understand the value to the leasing market of the space that we own. We have a hard and fast rule about what constitutes a deal that would fit the profile of Core Plus Fund 4. This fund acquires assets that have 4 years or more of lease term remaining and are 93% leased or better. This is consistent with the fund's low-risk profile, as well as to serve as a clear delineation from our value fund. In our recently invested predecessor fund, Core Plus Fund 3, the weighted average lease term at acquisition was approximately 8 years, and the average occupancy was above 99%. In terms of targeted returns for the fund, we aim for an initial 5% yield on cost at acquisition. This equates to a 6 to 7% cash-on-cash yield after procuring modest leverage at 50% LTV.
These initial yields will grow over time as most leases have contractual rent bumps that will escalate that income. Additionally, we aim to outperform on the buy side. We seek to achieve a 50 basis point delta better than market cap rates on acquisition. We're able to achieve this through our unique sourcing model, which I'll go into a little more detail in a little bit. Additionally, our model is to buy the single asset and sell the portfolio. We have observed a verifiable premium in portfolio pricing that we estimate today to be approximately 50 basis points. However, we do not underwrite this when evaluating the acquisition of individual properties. The portfolio premium simply allows us to outperform our targeted returns. We'll move to the next slide, which is 476, I believe, in the books. At Exeter, we are experts in supply chain real estate. This fund will be composed of assets that are critical across the entire supply chain. We are consistently listening to our customers, which are our tenants, and understanding their needs market by market and sub-market by sub-market to make sure that we target the appropriate market and the appropriate product in each market that is in line with this tenant demand, as well as the requisite property types across the industrial sector. On to the next slide, which is 478. I have the two slides. So I frequently get asked the question, what makes Exeter different? And why are we successful in a very competitive industrial market? Now, as I mentioned before, part of our secret sauce is our sourcing. We believe that real estate is local, and we have market officers in 24 markets around the United States who are intimately familiar with that specific market. Teams that reside in those markets are evaluating opportunities through the lens of their local knowledge of that city and its trends. These officers are reaching out to relationships that have been built locally over many years and include not just national reaching investment sales teams, but more importantly, smaller local sales teams, local leasing brokers, and local property owners. This allows us to see opportunities that others don't and see opportunities first. This results in seeing greater volume of potential deals whereby we can select the best designed, most leasable assets that will result in the best performing opportunities. In addition, at Exeter, we lease and property manage all of our buildings ourselves. We don't have third-party brokers or management companies do this for us, as we believe that we as fiduciaries are best aligned with you, our investors, to accomplish these goals. In other words, we want to retain all of the touches and communications with our tenants. This leads to increased tenant satisfaction, greater tenant retention, as well as outperformance of lease rates as we remain connected with the tenant throughout their experience. This is unique to Exeter, and we believe it is critical to our outperformance. The same market officers who acquire these buildings are also responsible for leasing them. The results of this are twofold. There's consistency across the asset life cycle and allows us to view each acquisition through the lens of leasing. Even in buildings that are well leased, like those that will be acquired by this fund, we feel it is important and critical to purchase functional real estate. In this way, if the tenant were to go bankrupt or move out, the space could quickly be released, mitigating our downside risk. As mentioned before, we are one of the only operators who specifically targets one-off buildings for acquisition, with the intent of selling large diversified portfolios to take advantage of their market premium. Large investors are willing to pay lower cap rates for the ability to deploy larger amounts of capital at one time, especially into a portfolio that allows the diversification of geography, tenancy, and industrial product types. I'll close with the last slide, 479, which this slide represents our general consolidated investment strategy and how we achieve our returns. So we seek to provide regular quarterly cash dividends based on the initial yield and grow that yield through contractual rent increases. These yields are enhanced by favorable debt at 50% leverage that is pooled, thereby receiving the most efficient market pricing. We operate this portfolio and manage tenant retention over the fund life and maximize rental rates on tenant roll, thereby creating a higher NOI, which is capped, creating value appreciation at each individual asset level. These assets are then sold in the portfolio, creating additional value through portfolio premium pricing. I'll turn it back over to Rayanne to close up our presentation.
Thank you. Lastly, I'll take you through the market fundamentals, which should be on your page 482 of your deck. And we expect the strength of the U.S. industrial real estate market will greatly support the investment objectives of the fund. Tenant demand has been exceptional during COVID due to a combination of baseline consumer demand plus e-commerce. And this has led to a scarcity of Class A warehouse space and therefore truly extraordinary 8% rental rate growth. So these are clearly great tailwinds for the income generation goals fund. In addition, the cost of new construction has risen 30 or 40% in the last 24 months. A combination of rising rental rates, higher intrinsic market value of all new warehouse stock are also great tailwinds for the capital value growth goals of the fund. Lastly, there continues to be incredible appetite among large global investors to own large diversified portfolios of income-producing industrial real estate. And this provides excellent liquidity for the fund. As Seth alluded to, we get inbound inquiries about the portfolios that our funds hold all the time. And New Mexico benefited from this phenomenon firsthand in the fourth quarter of 2021 through $10 billion worth of portfolio sales, one of which was the U.S. funds and the second was the European fund near the end of the year. So thank you all for your support across the years, for being our longtime partner, and thank you for expanding this important relationship into an additional industrial fund series with EQT Exeter.
All right, very good. Thank you, Ms. Chen and Mr. Elner, for being here with us to represent Exeter. And with that, we will go now to council questions for our staff, consultants, or the investor representative. Questions from council? Do we have a motion on the Exeter recommendation?
Madam Chair, based on the recommendations of the Council Investment Committee Advisor of the Townsend Group, SIC staff in general, produced the oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to Exeter Industrial Core Plus Fund 4, subject to and contingent upon New Mexico legal requirements, Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second that.
Very good. Thank you, Member Tejas. So we've got a motion from Member Lavender, second from Member Tejas. Any discussion on a motion for a $100 million investment into Exeter? Okay, if we could have Andy call the roll, please, on
Commissioner Garcia Richard.
Yes.
Yes. Secretary Romero. Yes. Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Tejas. Mr. Bingaman.
Yes.
Madam Chair, the motion carries unanimously.
Okay, thank you very much, and thank you to the folks on the line from Exeter for coming to present. Next,
thank you all so very much.
Yes.
Thank you.
We're going to go to agenda item 3G, our last investment vote, and this is for ACOR. I'm going to turn it back over to Mr. Sable and our consultants from AXIA.
Thank you, Madam Chair. Seventh inning stretch of sorts. So I'll switch hats to cover the fixed income piece of the agenda. There are two items in fixed income. One, as you pointed out, the voting item around the ACOR Credit Partners 2 investment recommendation, and then a non-voting item with respect to an update of our pacing analysis. Joining me today and leading the AXIA team is Trevor Jackson. And then from ACOR, we have Warren DeHaan, the co-CEO, and Mike Romo, head of capital raising. Staff and AXIA are collaborating to recommend a $150 million allocation to ACOR Credit Partners 2. The fund is a transitional commercial real estate lender pursuing a subordinated lending strategy with target returns in the 9 to 11% range. ACOR earns a return by originating whole loans to high-quality, well-capitalized operators and sponsors with proven track records. The GP employs approximately 2 turns of leverage. A typical structure might look like selling the A piece of the whole loan and retaining the mezzanine B tranche Those retained tranches typically carry coupons in the range of LIBOR 800 to 950 basis points. The loans themselves are protected by a 30% layer of sponsor equity. Among the reasons we like this investment, the team is robust. They have 4 founders with 20 years of history working together. Before ACOR, they ran Starwood's Public Mortgage REIT. Together, they have originated $70 billion in CRE loans, $26 billion of which were done at ACOR. The GP offers scale that's uncommon in the industry. They have a team of 100 investment professionals and are one of the largest CRE-focused private credit managers. They have an exclusive focus on debt, and so they don't compete with sponsors, and that gives them a sourcing advantage in the marketplace. Another item that we like is they have a highly selective, disciplined underwriting process. Indeed, less than 2% of last year's deals that entered the pipeline were actually closed. The rigor of the process has led to strong credit performance. Another component that we like is that these transitional lending strategies have a built-in de-risking mechanism, and that is that as sponsors execute against their business plans, they create equity value that de-risks the loan by adding to the equity buffer that I had mentioned previously. And then finally, there's a diversification component to the strategy. This is the first CRE-focused lending strategy in the private credit book, and that will serve to diversify the types of collateral against which our GPs are lending on our behalf. With that, I'll hand off to Trevor to present Axia's underwriting.
Thank you, Keith. Morning, Madam Chair and Council members. Trevor Jackson with Axia. As Keith mentioned, ACOR Credit Partners 2 is a real estate credit strategy focused on transitional commercial real estate space. ACOR is a highly resourced strategy run by an experienced team that has worked together for over 2 decades. As we look at your current credit portfolio, we believe that an allocation to real estate debt, as Keith mentioned, offers a good diversification from your current corporate credit strategies. And this strategy is in a space that has and will continue to see changes post-COVID, as well as structural opportunities as a significant amount of CRE loans mature. Additionally, general activity in the commercial real estate market continues to increase. On the allocation side, the portfolio is relatively light in lending strategies at the moment, and this allocation helps raise that category a bit. We did recommend a distressed allocation last month with Arbor Lane and now lending strategies. We will have more recommendations in this category in the coming months as we build the lending category further. Also, it's important to note that we have recommended large commitment bite sizes to put more money to work, especially given increases over the last year in overall assets, which Steve mentioned earlier. We will talk more about pacing after this ACOR review. I will now turn it over to Aaron Nessel, who will discuss the strategy in further detail from our research department. We also have Rebecca Hune on the line in our ODD group to answer any questions you may have. Please note, there's an abbreviated ODD report in your package for reference versus our longer 40-page document. I'll turn it over to Aaron.
Hi, everyone. Nice to speak with you again. I will aim to be brief here and give you a brief overview of our findings with respect to our investment and operational diligence on ACOR Credit Partners 2. We conducted our standard full investment and operational review for ACOR Credit Partners 2. It's worth noting we've previously underwritten other strategies and aspects of ACOR's business and have known the team for some time. Without reiterating much that has already been said, as mentioned, ACOR is a very experienced group that was founded in 2015. They initially raised capital from several large SMA investors, including a Japanese insurance company, Delphi, which is ACOR's largest investor today. ACOR launched its first commingled fund in 2018, focused on transitional lending, which is the strategy we're talking about today, and also launched a special situations fund in 2020 as more of a higher risk, higher return oriented strategy that we have also underwritten. In terms of this strategy, as Keith mentioned, it's really focused on originating senior mortgages secured by transitional commercial real estate. The loan sizes that will be targeted here typically range from 30 to 300 million, and ACOR is pretty well positioned in the large loan segment of this market, which we do think is a competitive advantage. The assets will have a range of business plans, including renovations and lease-ups to redevelopment and new construction, to really sort of moving across what we consider to be the transitional segment of this market. And target returns are 9 to 11% net. The primary terms are as follows. ACOR is looking to raise $1 to $2 billion with a first close imminently, I believe by the end of Q1. The investment period is 3 years from the final close. The harvest period is 5 years. Standard fees are 1.35% management, though there are some incentives as well. In terms of our findings on the merit side, we really believe ACOR is really benefits from its size, experience, and the quality of the team. The team has been together for over 2 decades, and we think their continuity should be advantageous in terms of maintaining relationships in sourcing channels in the industry. ACOR also has one of the largest asset management teams with experience working out and operating assets, should the market turn or credits run into trouble. As previously mentioned, we think scale is really a competitive advantage in this market, and ACOR certainly has scale by virtue of its large capital base, its ability to take down increasingly large loans in a competitive market, and should be well positioned to continue to do so. Lastly, ACOR has a strong track record across its SMAs and its first commingled fund with no credit losses since inception. One of the considerations that we noted is, there is some potential business complexity given ACOR's significant relationship with Delphi and the presence of an external investor that we've been able to get comfortable given the separation of the external owners from investment decisions, the greater diversification of ACOR's investor base today, and the benefits of scale that I mentioned with Delphi's capital base as well. So for all these reasons, we have certainly had conviction in ACOR, and we believe they are well equipped to take advantage of an attractive opportunity set in commercial real estate lending. We are, of course, happy to address any questions you may have, or we may be going to ACOR next, whatever the best order is.
Yeah, I think we should go to the representatives from ACOR that we have on the line.
Hello, can you hear us?
Yes.
Hi, this is Mike Romo. Thank you, Madam Chair, council members, Keith, Trevor, Aaron, Rebecca. We sincerely appreciate the opportunity to create this new partnership with you all, and appreciate the background. Given that it's later in the schedule and many hit the points that I was gonna cover, I'll be very brief, and I'll turn it over to Warren to talk about where we see the opportunities and what we think is compelling. As mentioned, we were founded several years ago, really with an intense focus on commercial real estate lending. That's the origins, that's the DNA of the team. Cycle tested, the relationship with Delphi was important to help us launch the business. And so, with that, we've been able to become a very formidable group within the industry in a competitive market. But where we operate in the, on average, our loan is $80 million and we can flex up to $300 million, as Aaron touched on. That becomes a real differentiator. It really allows us to focus on high credit quality. Our borrowers are putting significant investment skin in the game, if you will. And as alluded to, that's why as of the $26 billion that we've invested, we've had zero loss of principal or interest. And, that takes scale, that takes expertise, and that takes intense credit. And that's what we take a lot of pride on. So, with that, we've grown to over 100 people. We have offices in all of the key markets where we're originating deals in San Francisco, LA, New York, Florida, and Dallas. And that really becomes a competitive advantage. If you flip to page 535 in your book, this is a snapshot of the organization. Another key point, the 4 founders, Boyd, Warren, Chris, and Stu, all have a vote on the IC, so it requires unanimous vote. and this is the experience that we've touched on. Again, we compete on scale, we compete on expertise, and we compete on existing relationships. Job one for us is preservation of your capital. You want to ensure that that there are no losses, and that we want to focus on that from a credit and from a due diligence standpoint. We're very focused on cash on cash. Fund one, for example, is producing a 10% return, and we're also looking for, as mentioned, a net 9 to 11, which Fund one is on pace to achieve. We look at about $250 billion a year in loans, and we only execute on 2 to 3. So we do about $6 billion, but we have the infrastructure and the scale where we could easily double that capacity without changing any of our credit metrics or the quality of the investments that we make. And then going back, finally, relationships are key. We're in the trust business. We don't take that lightly. We have 65 of our almost 400 borrowers that have at least 3 loans with us. And so, that is the ultimate compliment, that your customers come back and they want to do business with you. And it's with that deal flow and that high quality pipeline that helps us create the portfolios that we think provide the best risk-adjusted return for you, our investors. Finally, on page 537, that's a snapshot of the track record. We take a lot of pride in that. So if you fast forward to end of year, we are now over 400 loans and $30 billion in 0 losses. And as we underwrite the portfolio constantly, we don't anticipate any losses going forward. So, that allows us to be on the offense. That allows us to be hyper-focused on the here and the now and where we think the best opportunities are. Because we're cross-market, cross-property type, we can be highly selective in the investments that we make on your behalf. And with that, I'll turn it over to Warren to shed a little more light on what exactly we're looking at today.
Thank you, Mike, and thanks everyone on the phone. I want to thank the members of the council. This is a great honor for us to have the opportunity to partner with you. So back to the word focus. We have this intense focus on capital preservation, on strong, predictable cash-on-cash distributions, and using our large origination, credit, and asset management footprint to generate the best risk-adjusted returns in the market. Let me touch on the market for a second and why we really like where we are today. Firstly, the core of our borrowers are institutional, very high-quality, real estate-oriented investors. And generally speaking, they're paired up with a best-in-class local or regional operating partner that is in a position to execute the local business plan. Another fact that I like a lot that is different from 2007 or 2008 is that the requests that our borrowers have are, generally speaking, conservative leverage requests. We have not seen them push the leverage spectrum, but they do require flexibility from their lenders in terms of prepayment, future fundings, and they require great asset management, which ACOR is in a great position to service those clients. Secondly, the investment sales market is starting to reach record highs in terms of volumes. Q4 2021 was higher than Q4 2019, and we're expecting tremendous investment sales volume in 2022 for the foreseeable future. What this means for us is about 70% of our loans are financings for new acquisitions. That means these institutional borrowers are coming to the table with fresh equity, fresh business plans, and in general, if you look at Fund 1, where we're at about 67% loan to value. So a lot of fresh equity in those deals. I also like the positioning of the market because commercial real estate has historically performed well in inflationary environments. That's as a general comment. Not all assets will benefit, but as a general comment, because rents you're able to reset with a high degree of frequency, whether it's monthly or annually, or whether or not there's inflation adjusted in the leases, the income side of the equation has an opportunity to keep up with inflation. Secondly, keep in mind, almost all of our loans are floating rate. so that to the extent that rates rises, we do get the benefit of the base rate increasing. Commercial real estate is also viewed as a safer asset class with attractive relative returns, and so we're seeing a tremendous amount of interest from investors to acquire commercial real estate. The other point I'll just make is that as a lender, we do have the opportunity to conservatively underwrite our loans and account for any increases in inherent interest rates or cap rates. So given our national footprint and the number of investment opportunities we see, we can be selective about which deals we want to win, i.e. the best borrowers, the best business plans, and the most attractive basis. I would tell you that one of the favorite things about my job is the scale of ACOR. And the important point about that is that we get to look at and underwrite every one big deals in the market, and we get to select the ones that we want to pursue. And because of our positioning as a trusted go-to lender without any conflict on the equity side, we get to see the beneficiaries of many first and last looks to win the business we want to. I just want to quickly touch on page 541, which is our investment selection process. This gives you a sense of the scale and our selectivity. In the top right-hand column, you look under inquiries. These are actionable inquiries. In other words, these are deals that in one way, shape, or form would fit ACOR investment parameters. Now, if I focus your eye down to the bottom, you'll see the percentage of inquiries closed. You can see that our hit rate is somewhere between 2 and 3%. That means that we're turning down 96, 97% of the deals we look at, or we don't believe that those deals represent good relative returns, or for one reason or another, we're going to pass or are being, outbid by somebody else. But the point of this chart is to show the scale at over $1 trillion of inquiry, or 14,000 loans that we've analyzed since over the last 5 years, and we close generally 2 to 3%. The next page I'd like to focus you on for 1 second is page 542. This is our investment selection philosophy. We generally live by 3 tenets: basis, borrower, and business plan. On basis, this is a key attribute of making intelligent investment decisions over a long period of time. The loan basis is important. The loan basis, i.e. the dollar per square foot or dollar per door, is very important as a metric on a historical basis, as well as historical cash flows. We focus on comparable property sales, not just recent property sales, but also over a longer term period, as well as rental rates over multiple cycles. We're very focused on not only our last dollar investment basis, but also the last dollar investment basis of our sponsor, to make sure that we believe that not only does our basis feel defensible, but so is the borrower's basis in their business plan. The second tenet is the borrower, the quality of the borrower. We're focused on institutional, well-capitalized operators, private equity shops, hedge funds, with the best local and regional operators. As Mike said, 67% of our borrowers have 3 or more loans with us, and we do have long-standing relationships with these borrowers, both in the good times and the bad times. So we know how to work with them to the extent that something goes off business plan. And thirdly is the business plan. Is the business plan fully capitalized? Is the business plan executable, in our opinion? And can our loan structure be structured in such a way that it is going to result in the best outcome for all stakeholders? In conclusion, I focus you back on our focus, which is the capital preservation, strong cash distributions, and the ecosystem that ACOR has to get first and last looks. Secondly, our track record of achieving above expected returns with no loss of interest or principal, our ability to source these assets, underwrite them, and asset manage them in scale. And the final point is that the market, there are real good tailwinds in the market today, which further solidify our position and the opportunity that we face going forward. With that, I thank you for the opportunity, and I'll turn it over to you.
Very good, Mr. Dahan. We appreciate you being on with us for questions and your presentation. So now we're going to go to questions from the council for either our staff, the folks at AXIA, or the representatives from ACOR. Hearing no questions, do we have a motion?
Yes, Madam Chair. Let's see. My computer is not treating me very happily today. Based on the recommendation of the Council Investment Committee, Advisor, AXIA, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $150 million to ACOR Credit Partners II, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Very good. Thank you, Member Lavender. Do we have a second?
Second, John.
Okay, go ahead, John.
Very good. We've got a motion from Member Lavender, second from Member Bingaman. Any discussion on the motion? Hearing none, I'll go to Andy for a roll call vote on the ACOR investment recommendation.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rossman.
Yes.
Mr. Taya.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries unanimously.
Very good. And we thank the representatives from ACOR, Mr. Romo and Mr. Dahan, for being on to give their presentation and to take questions. Thank you, gentlemen.
Thank you. Thanks very much.
Very good. So with that, yes?
Madam
Yes?
Chair, it's Harold. I just want to say that we've been assured by Vince and the staff that we won't have these kinds of as many investments to consider, at least not in the near future. But I appreciate the fact that we were able to move these through, and I think that we'll have fewer coming down the line.
Very good. All right, so rounding out our investment portion of the meeting, we have the promised pacing review, non-core fixed income from Mr. Sable and AXIA.
Madam Chair, thank you. It's Keith Sable again. Given the persistent gap that we've seen between target and actual allocations of private credit, we chose to revisit the pacing model. Key drivers of that gap over time have been numerous, but the three that I would call out would be we've seen really robust flows from the land office, and obviously the private asset classes generally take longer to deploy capital. We've seen extraordinary performance on the portfolio as a whole, and that also leaves us struggling to maintain the target weight in the portfolio. And then the final piece is a demand-driven factor, and that is that we've seen client fund interest in private credit allocations increase over time, and that's necessitated additional work be done in the private credit space. Without giving away the punchline, I'll say that we're concluding the pacing needs to increase pretty substantially over historical numbers. The implications of that will include an uptick ultimately in the number and size of allocations that we'll need to consider going forward. I'll stop there and hand it off to Trevor to get into the details.
Thank you, Keith. Morning again, members of the council. I'm going to reference a couple of pages in your packet. And I'll start with, page 557 and 558 under your numbering system. As Keith mentioned, pacing is one that we try to do often. We typically try to do it on an annual basis. It gives us kind of a temperature of kind of where we are. Given a lot of changes in portfolios, typically not as extreme as we've seen in the last 2 years, but it just, it's a right sizing. And so we've seen, 2020 was difficult and challenges in the market. And then 2021 saw a lot of that bounce back strongly. But as Keith mentioned, you have a lot of utilization in this particular portfolio and a lot of growth in your portfolio overall. And so, pacing itself, not perfect. It's a situation where we look for directional aspects of it to say, okay, we're going to increase it. How much? But does it have to hit exactly that number? Not at all. Because in the course of the next time you look at it again, it can be slightly different. So the key is if you're on the directional pace and you're roughly in the ballpark. So just want to point that out, that it's not, it's been art and it's been science. If you look at page 558, our methodology takes into account your actual portfolio. So net asset growth, timing of capital calls, timing of distributions, and we run that through our model. And then we take what you currently have and we put estimates on certain categories and asset classes you'd be involved in and what that would look like, pacing out. So it isn't something that's just really we're making the numbers up completely or just making estimates. We're trying to take real actual cash flows that are coming into your portfolio to use as a baseline for future pacing. And kind of where you are right now, you're sitting at a current allocation of roughly about 10% as of 6/30 numbers last year. Private assets are typically lag, and your target's roughly 5.2%. So you've got a ways to go. When we look at our pacing, it requires you committing about $900 million a year to get close to that 15.2%. Well, the next page we'll get into some details on that. But just to give you an idea, last year for 2021, your estimate was $400 million, and we came in a little higher than that. But we're really talking about more than doubling our recommendation to more than double the current pacing that you have, just to keep up with all the gains in the portfolio and utilization, as Keith mentioned. So if you go to next page 559, number 4 in our deck, you'll see a couple of scenarios here. So,
okay.
Go ahead. Sorry.
What?
You're breaking up. Can you repeat that?
Trevor, this is Keith. Just keep going.
Okay, I'll keep going. So on page 559, we run a couple of pacing here. So we have the blue line shows the growth of your assets at 2% annual plan growth. Green is a 0 annual plan growth. Purple, 3% annual plan growth, and red, 4% annual plan growth. We pick these with Keith and Vince's help of just saying what seems reasonable in the portfolio. We've seen a lot of strong gains in the last year, but we use this as kind of a longer-term baseline, and with 2% being kind of the one we really look at. And then, so you can look at, if you look at the blue line below, we're in 2022, at the pacing we're recommending is $900 million per year. You would get to your full allocation of 15.2% by 2028. So 7 years to get there. If the portfolio grows a little less, at 0 plan growth, you would get there sooner. And if it grows more, at 3% or 4%, it would take longer to get there. Makes sense? Your portfolio is growing and you need to kind of keep pace with that. You can see we've made sure the recommendation of $900 million is the same across all the years to keep it consistent. And then you'll see the teal bars is your NAV in millions to show kind of where you are. So again, at a 2%, which is kind of our baseline, it would take you 7 years to get to your 15.2% target allocation. And at $900 million, at $150 million per, on average, commitment bite sizes, you will have a number of names to kind of come to the board to discuss. Let me pause there to see if any questions. I have one more slide, but any questions on this page? Okay. In your appendix, we included one other slide, and that's slide 561. And we, Keith and I and the team have been talking about an SMA, a separately managed account. We wanted to just show you what it would look like if you had a $250 million separately managed account and what that would do to your pacing. If we look at the same blue line, which is 2% plan growth as our baseline, you can see you hit that dotted yellow, which is your target, about 2 years earlier than the 2028 number in the prior slide. And why is that? That's because in addition to having more control in SMA of what you're actually investing in, you also get the opportunity to recycle capital a little quicker. And that recycled capital means you put more money in the ground to work, and you get to your targets a little quicker. So that's something in discussion for this year that may or may not occur, but at least we wanted to model it to give you a better idea if you did something like that. I'll stop there.
Thank you.
Yep.
Thank you, Trevor. Madam Chairman, back to you.
Okay. Any questions on the pacing review? All right. Thank you, gentlemen. Sounds like it's a good problem to have because we are making too much money too quickly. So let's go on to finance matters, agenda item 4, and I'm going to turn it over to Member Tejas to give us the audit committee report.
Okay, Madam Chair, council members, just real quick. I know that Brent's here and he'll have more to say about this, but we met yesterday in our audit committee. We discussed, of course, the approval of the summary notes from our prior meeting. We talked about the FY23 appropriation requests and comparison between, the different legislation that was proposed this year. And we reviewed investment holdings report for January and had a pretty robust discussion on how the legislation from this session impacts our investments and our financials. So with that, if Brent's available, take it away.
Sure. Thank you, Madam Chair. I'll be brief. Just a couple of comments. I'm on page 568. I just wanted to point out, probably if we can, there's a 3/31 deadline for the agreed upon procedures reports that are upcoming for the first 2 quarters of the fiscal year. We should hopefully have those for the next meeting, although they do have a March deadline, so it depends on how the auditors push up against that deadline. If we don't have it next month, we'll have it in April. I did want to point out into Nick's comments, the appropriation request that we made for fiscal year 23, and we discussed this yesterday, was $64.3 million, which was a 15% increase over fiscal year 22. We actually, and this was fairly unusual relative to past history, not only did we get what we asked for, they actually added another $187,000 for the 200s, which is the payroll category. And that increase came about through discussions with LFC, and they had some concerns about us being able to recruit and do that effectively going forward. So we're very happy with the request that we made, but certainly more happy with what we ended up with. Nothing other to report. I did.
It's been signed yet.
Pardon me?
I said don't speak too soon. I don't think HB2 has been signed yet.
Okay. Hey, I'm glad you said that, Madam Chair. It is all subject to the approval of the governor, so we're still waiting for that approval. But assuming we get that approval, you're exactly right. I did want to point out, as is indicated on the notes of the IHR, which are on page 612, that we did have a very large contribution to the Early Childhood Education and Care Fund coming in January. This was an amount that was accrued at the end of the fiscal year. We were notified by DFA that a limit had been reached on the Tax Stabilization Reserve Fund, and because of those reserves that we had, the money went into the Early Childhood Education and Care Fund to the, like I said, to the amount of $342 million, which is very good. There was some discussion on the distributions out of the Early Childhood Education and Care Fund. If everybody recalls, in July of this year, we made a $20 million distribution, which was spelled out in the statute. For the next fiscal year, starting in July, fiscal year 23, we will be distributing probably $30 million. And something to be aware of is that large amount that we just received in will not be a factor in that future distribution because it came in after the end of the calendar year, which is built into the calculation. And then other than that, I just wanted to let everybody know that, certainly we're seeing some choppiness in the market, and today the market's down some. I'm still anticipating doing a bar to get us through the end of the fiscal year, just in case it's needed. It's potentially not going to be needed, depending upon what the market does, but I don't want to wait around and find out at the last moment that I need to do it. And then the last item I wanted to mention, we did do a true up of the distributions to the SBIC that was discussed yesterday in the audit committee. We distributed another $17+ million to them, which gets them to 2% of the severance tax permanent fund. And that concludes all my comments unless there's questions.
Very good. Thank you, Mr. Schiff. And Member Tejas, questions from council? All right, we're going to move to our last voting item, which is our Open Meetings Act resolution. I'll turn it over to Mr. Brown.
Okay, what you have before you, this is Bruce Brown. What you have before you is the Open Meetings resolution for 2022. It's virtually the same as was passed last year. And it's just the way we comply with the Open Meetings Act. It discusses how meetings will be held, how they'll be notified, and under what circumstances they'll be virtual. So unless there are any questions, I think it's a fairly straightforward matter.
And that begins on page 614.
I'm sorry, page 615.
Madam Chair?
Or 614, sorry.
Is that Member Romero?
Yes, ma'am. Thank you very much. I don't think it has so much to do with the Open Meetings Act, but just a question. I know that earlier that one of the members suggested that more council members participate in the investment meetings that are going on. I just question whether or not we can do that. If we have a majority of the state investment council meetings attending that, does that become a meeting of the investment council versus a subcommittee meeting?
It would become a meeting, but because the way our Open Meetings Act is formed, we give proper notice. The notice of the investment committee meetings is virtually the same as the notice for the regular meetings. So there wouldn't be a difference. The danger is that it changes the nature of the meeting from a recommendation meeting to a meeting that's capable of actually making decisions on these type of issues. So it does create a limit to how many people can actually attend or should actually attend the meetings, but it would not create an Open Meetings Act just because of Open Meetings Act problem, just because of the way we give notice to our investment committee.
Thank you. I think it's just something that we need to be aware of. So thank you, Madam Chair.
Thank you, Member Romero. Further questions about the Open Meetings Act resolution for 2022? Any word on whether or not we will be returning to in-person meetings?
We have no such word, Commissioner. It's something that we're constantly monitoring, and we'll sure let you know when that is doable.
Okay.
This is Harold. I sure hope that happens fairly quickly because this is getting really old, being on the phone.
We do appreciate folks staying on the phone for this marathon 3+ hour meeting.
Madam Chair, this is Blake.
Yes. Member Rawson, do you have a motion?
I have a motion. I move that our next meeting be in person.
Well, I'll second that.
We appreciate the sentiment for sure, Member Rawson.
No, it's a legitimate motion. I think we need to make a decision And if we get overridden, then we get overridden. But we need to make a formal decision. This is what we're going to do. I think it's fair to the public. I think it's fair to the members. I think it's fair to the staff.
Hi, everyone.
This
is Evan. May I interject? We have open meetings requirements. I think we have to provide notice of motion. So it might be something that we probably should wait until next meeting if you want to make that motion, just because of our public notice requirements. Respectfully, Mr. Rawson.
You can certainly put it on the agenda for next time if you'd like, Member Rawson.
Put it on the agenda.
Any further discussion on the Open Meetings Act resolution, or I'm happy to entertain a motion to pass it.
So moved, Nick.
Well, I've got to ask a question then. There's no indication that a motion is going to be called to adjourn. I mean, if we want to get ridiculous about it, but I'll second the motion.
All right, so we have a motion to pass our 2022 Open Meetings Resolution and by Member Taylor and a second by Member Rawson. I'm going to have Andy take a roll call vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Tejas.
Yes.
Mr. Bingaman.
Yes.
Yes.
Madam Chair, that motion passes unanimously.
All right, very good. So we will move on to old or new business, agenda item 5A. Any old or new business from council, staff? All right, I'm going to announce for the public that our next SIC meeting is scheduled for Tuesday, March 22nd. And we will stay tuned on to whether or not that will be called in person or telephonically. And with that, we'll move to public comment, agenda item 6. Do we have any public comment to be read into the record, Mr. Woolman?
Madam Chair, we do not have any public comments submitted today.
Thank you very much. So with that, I'm going to entertain a motion to adjourn. Is there a motion to adjourn?
This is Harold. So moved.
Okay, we have a motion by Member Lavender. Do we have a second?
This is Tim.
All right, we have a second by Member Eichenberg. Mr. Rawson, do we need to take a roll call vote on an adjournment motion?
I don't think so.
Okay. Any objection to adjourning? All right.
Thank you, Madam Chair.
Okay.
Thank you.
We are adjourned. Thank you, folks.
Thank you all. Bye, everybody.